90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds on the global economic recovery.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, this is Bloomberg Surveillance, and here's the price action. It is truly yesterday upside down. The Nasdaq down yesterday by 2.4%. Futures this morning up 2.4%. The S&P 500 futures bouncing back by more than a percentage point. Yesterday down 0.5%. Leading those losses, big tech. Shout out to Lou Wang. The S&P 500 yesterday, a quarter of its members, 52-week highs. The weight of big tech just sucking us lower. And the divergence between some of these indices, really interesting too. We'll talk about that a little bit later. Switch up the board and get to the bond market. 2s, 10s, 30s. Through this week, 3-year auction today. Lisa was talking about that. 10s tomorrow. On Thursday, we get 30s. This morning, yields all the way in. Lower. Bull flattener down 7 basis points on 30s to 224, on 10s to about 153. A total turnaround. And these yields driving everything from big tech in the equity market to the FX market. The obvious read-through has just been stronger dollar in yesterday's session. Switch up the board and finish on this. The dollar against the lira has seen a 7-8 percentage point move over the last month. In today's session, dollar lira coming back in 2%. That is lira strength. The Aussie strength. The euro strength. This morning, Tom, it is about dollar weakness, and it's broad-based against the low yielders in Europe, against the commodity currencies, against the high yielders in EM2.
Two ideas there. Swiss franc through to new weakness here on the low yield idea. And John, I'd really emphasize a 2-year yield to 4 digits, 0.1587. The 2-year is on the move. Just because of time, I want to dive into this, and we celebrate right now the career of David Pearl of Epic Investment Partners. He is the mechanical engineer out of Penn and Stanford, and of course, the world of cash flow resides on the shoulders of Bill Priest and David Pearl at Epic Investments. Their books are absolutely definitive. David, we were talking beforehand, and you've got the University of Pennsylvania Pictet yellow slide rule there. Throw up that slide rule that you had years ago. I mean, I think there it is, folks. For those of you younger, this is how we got through school, and you can't understand logs unless you physically use a slide rule. David Pearl, this is all ancient history. Now the HP12C is ancient history. Why do those calculators still have value when you calculate the cash flow forward?
Oh, it's good to have something you rely on that's easy to use. Today, of course, you could plug any of this into your computer or your phone and get the answer for IRR or discounted cash flows, but it's still nice to do it by hand. So all of us keep these around just because we're used to them and they're comfortable.
Is it hard in a booming economy coming out of pandemic to discern quality cash flow? Is it hard for you and Bill right now to figure out who the winners are on cash flow, or is it easy beans?
It's actually been really good coming out of this. You know, last year during the pandemic, which really hurt from February through September, you know, the market just rewarded companies that could do business during a lockdown, which tended to be internet and very high growth companies, many of which had no earnings. Think of Netflix in real cash flow terms anyway. And the valuations got quite absurd. Of course, the Fed helped this by bringing rates to zero. So during those 9 months, the companies that had no earnings beat the companies that had earnings by something like 4x. Then you get to the companies that had earnings, and we got to record valuations in the stock market. So then the have-nots, which were the companies who were locked down, who were economically sensitive, became extremely cheap, whether they were consumer discretionary, financials, or industrials. And they have taken off. They really started at the beginning of Q4, and the Pfizer vaccine approval was the catalyst. And those stocks, it's not just value, it really is economic sensitivity stocks, have outperformed ever since, including this year.
So, David, this is the consensus trade, right? That the cyclicals are going to outperform. Some of the less loved stocks are going to do the best this year, as big tech and some of the others that have outperformed will underperform. And yet, I'm struggling to understand what the model is here. How do you determine whether this is just a recovery trade and how much more it has to run, given the low yield environment that we have that's generated this wall of cash into equities?
Yeah. So, you know, what we're seeing, the catalyst is people are getting back into society. We're returning to normalcy. We just had, we're about to have a $2 trillion stimulus. So the propensity of consumers to spend is very high. Now, savings, personal savings actually went up during this period. Obviously, if you have a job, there weren't things to spend on. So we're going to see spending by consumers, which is 70% of GDP, really rocket up. And it's going to be in areas like restaurants, travel, entertainment, in particular, are going to have the biggest rebounds. Now, the market has already anticipated some of that for sure, but there's a much longer trajectory of this because it's going to take couple years to get back to where we were before the pandemic minimum, and in travel it could take 2 or 3 years. So there's really upside in some of these stocks as you go forward. The other thing is the valuations were incredibly low. In financials, they were trading below tangible book. Now, usually we don't care about book value, but tangible book is cash. So they were trading as if they were going to be insolvent below their cash value. So even though financials are up something like 30 to 50%, they have for the next year to 2 years a great outlook as loan volume starts to ramp up. Credit, of course, improves as we get out of this. And the yield curve steepening increases profitability. So 3 reasons why financials keep going for quite a while. Now, that said, we see the biggest opportunities in mid-cap stocks. Mid-cap have underperformed those mega-cap stocks over the last 2 to 3 years by a lot. So we have a big valuation difference. So the small and mid-sized banks are growing in the double digits and trading at 10 to 12 times earnings with high ROEs. And again, it's going to accelerate.
David, key here is mid-cap. Just let me jump in quickly because I think this is really important. I want you to build on this. There's a research void, and possibly in mid-caps, and I think we've talked about this before. It was Chris Harvey of Wells Fargo that turned around recently and said it's a stock picker's paradise right now. There's many people who haven't picked stocks for a long, long time because you've been able to sit in the benchmark, the S&P 500, and mint money through the whole of the last bull market. Can you tell me where that research void is right now, away from the mega caps, and where you find your edge?
Yeah, absolutely. The market was so narrow last year that, 6 stocks had 2/3 of the return of the stock market, which are basically the FANG stocks. So now, as you have the other 2,994 stocks of the Russell 3000 to pick from, you really have some fertile territory. So we have our own analysts. This is where the buy side can really shine. And every study academically says if you're good at picking stocks, you're going to do better in small and mid-cap stocks because they're less efficient. There is less research coverage. I mean, if you think of, Apple and Amazon, literally 100 analysts cover it. we have stocks in the portfolio that are in the $10 billion market cap range that have one or two analysts. Smaller than that, we have stocks with zero sell-side analyst coverage. So it's our own analysts who talk to management. So really, it does pay to do your own research in small and mid cap. And again, some of these are pretty substantial companies, but they're not going to get the coverage. So there is a real advantage in this. We see this in the thousands of mid-sized banks, small and mid banks, as well as industrial companies, where there just isn't a lot of coverage and they're not interesting to most of Wall Street.
And I think the price action of the last 24 hours, David, really underlined that. Tom, just looking at the numbers, this again from Lou Wang and the team at Bloomberg. If you took out Facebook, Amazon, Apple, Microsoft and Tesla from the price action yesterday, the S&P 500 had an up day. Not a down day, just driven by a handful of stocks.
It's the idea of rotation. And then, David, let's bring this back to foundation. Has this been reversion to the mean, or do we extend beyond that with the beleaguered of the last 5 years?
Yeah, I think this goes on longer because that's where the growth of profit is. It's the fact that we went from a period where restaurants were closed, leisure, travel was closed, to where they're getting back to normal. So they're going to have the fastest year-over-year revenue and earnings growth, whereas the typical growth stocks, they're fine, but it's not going to get any better. In fact, for like an Amazon, the comps year over year are going to be harder. And of course, their valuations, we can argue this, but the valuations are very, very full.
David, we got to go because of time, David, but I know you're retiring in 2026, so we want to be sure we have you on a few more times before you retire. And tell Bill Priest he can't retire. Priest can't retire, can't do it.
We say he's only leaving the office one way. That's it.
That's it, David. Thank you so much. Great. Legendary in cash flow. Folks, for those of you in Global Wall Street, you must read William Priest on cash flow and on shareholder value. It is absolutely a must read. John, that's great. I mean, I love these guys that are just pure, let's find the cash flow.
Yeah, just tremendous to catch up with David Pearl of Epic Investments. And his point about coverage, Tom, I think is absolutely critical. The big mega caps, the Apples of this world, they're the most researched companies on the planet. Where'd you get an edge? If this is truly what Chris Harvey of Wells Fargo called a stock picker's paradise, where'd you find that edge right now?
It's gospel to me, small cap, mid cap, and you got to be there. And I really would emphasize, John, that small cap goes to sleep for a while. Mid cap is there every day trying to get it done in America.
I do wonder how much Robinhood complicates the story, especially given the fact that you've got a lot of companies moving not in fundamentals, perhaps just specific meme stocks. At the same time, John, they are taking on a bigger portion of the index. I know it's specific stock picking, which is what David Pearl's talking about, but it's really interesting to see how distorted from fundamentals and cash flow some of these names really have gotten.
Lisa, you are dead on. And John, I'm going to give you two key words here. Lori Calvasina. She's done the best work I've seen on what Lisa's talking about, which is people are so afraid of Robinhood, they're hiding in value, and they've missed all the growthiness of mid-cap and small-cap.
Laurie Calvasina of RBC has been absolutely fantastic. Coming up on this program, I'm pleased to say, Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar, on the CDC's new guidelines for those of you that have been vaccinated, what you can and still can't do. In the equity market, up 43 on the S&P, we recover by more than 1 percentage point. The Nasdaq absolutely flying. It is yesterday upside down in the bond market. Yields up yesterday, yields down this morning, down almost 7 basis points to 1.5246%. From New York, alongside Tom Keene, Lisa Abramovich, I'm Jonathan Ferro. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. The House takes up President Biden's $1.9 trillion stimulus bill today. Sometime tomorrow, the Democratic-led chamber is expected to approve the measure. Treasury Secretary Janet Yellen is dismissing fears that the package is so big that it will cause an inflation problem. She says if it turns out to be inflationary, there are tools to deal with that. Donald Trump has now backed off his threat to sue Republicans for using his name to raise money. The Republican National Committee now says the former president has given approval for his name to be used in fundraising and other materials. Still, he said in a statement last night that contributions should only be made to his political action committee and other entities he controls. A Swiss drug maker, ADN Pharma, will produce Russia's Sputnik coronavirus vaccine at a factory in Italy. It's the first European production deal for the Russian shot. Italy's Prime Minister Mario Draghi has promised to speed up the country's vaccination campaign. And the founder and CEO of Zoom has donated more than a third of his stake in the company. According to filings, Eric Yuan donated almost 18 million shares at the conferencing technology firm last week. The shares were valued at about $6 billion. No word who the recipient is. And Gap is said to be considering a sale of its operations in China. Bloomberg's learned that deliberations are at an early stage and Gap could decide to keep the business. Revenue from Asia has been shrinking and accounts for about 5% of Gap's total. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Fully vaccinated people can visit with other fully vaccinated people in small gatherings indoors without wearing masks or physical distancing. Remember, here we are talking about private settings where everyone is vaccinated.
Dr. Rochelle Walensky there of the CDC and what vaccinated people can do now. From New York City, for our audience worldwide, good morning to you all. Alongside Tom Keane, Lisa Bramwitz, I'm Jonathan Ferro. Here's the price action. It's Tuesday. Let's whip through it for you very quickly. Up 45, call it 46 points higher on the S&P 500. We are positive by a little more than 1%, and we are absolutely flying on the NASDAQ. A real turnaround from the last 24 hours. In the bond market, Tom, yields up, then yields lower, down almost 7 basis points to 1.5246%. And this story, this great rotation, it all started with that first headline on that vaccine at the start of November, Tom. Since then, to borrow a phrase, small caps truly to the moon.
Well, to the moon. And again, I want to emphasize in the last hour even of our simulcast, we've seen a nice oomph to this market, a nice lift as well. Right now, on the headline that I'm sure all of you saw yesterday from the CDC of Atlanta, Amish Adalja joins us with Johns Hopkins Center for Health Security. Dr. Adalja, I remember CDC as the cool place to work a million years ago. They did malaria out of World War II and then built out the excellence of America in microbiology and virology. That headline yesterday, when you saw it, how did you respond?
I thought this was something that was well anticipated, that people wanted to get guidance like this. And I expected the CDC guidance to be cautious, and I think they were pretty cautious, but at least it shows people what the future holds. And it's important to remember that this CDC guidance is a first iteration. It is something that will evolve as more data becomes available and as the CDC gets more comfortable. So expect this to be revised and more guidance change for those who are vaccinated. And it really shows you why vaccination is important, why it will change your life and give you your life back.
Dr. Adalja, why are they being so conservative with their approach?
I think they're being conservative because they're a big public health agency. They're talking about population health. They want to get it completely right. They've had some missteps during the early parts of this pandemic, and they don't want to relive that. So they're going to make a decision that's data-driven. So once they think enough data has accumulated, for example, on asymptomatic spread, maybe from countries like Israel, where so many people have been vaccinated, they're going to have this threshold crossed, and then they're going to make a change. So I think it's not uncommon for public health agencies to be more cautious than what I, as an individual infectious disease doctor, might tell my patient who's been vaccinated. But so I do think it's par for the course. That's what we expected.
The weight of the risks, though, aren't equal. The idea that the more people who get vaccinated, the more the transmission mechanism seems to be broken, and we see a decline in the number of cases. Can we get a sense of how much the vaccinations that have already been distributed have already reduced the spread of the virus, and if we got it that much more quickly, if we'd have that much slower of a spread?
The general principle holds, but it's very hard to untangle mask wearing, social distancing, how much population immunity is around because people got infected, plus the vaccine. The vaccine component is going to increase over time. And each new vaccine that goes into someone's arms makes the life of that virus makes it more difficult because they have less people that they can infect. But it's hard to know exactly what happens there. But I do think you're going to see, for example, if you can gather indoors with vaccinated people, what's the difference between doing that and having vaccinated people in a restaurant? It's probably not that big of a difference. And I think you're going to see more guidance tied to reopenings of certain restaurants and capacity as they get more comfortable, as we get more data.
We've made tremendous progress, and some states are already moving forward pretty quickly. Texas reopening, dropping the mask mandate. I think Wyoming joining them in the last 24 hours. That'll start next week, I believe. Doctor, how concerned are you about that right now?
I'm concerned about one aspect of it, and that's dropping of the mask mandates. I think there is an argument to be made for capacity, increasing capacity at stores and increasing capacity at restaurants. But in order to do that safely from a business continuity perspective, you want your patrons, you want your employees to still be wearing masks because there's still tens of thousands of cases occurring every day. We still don't have enough people vaccinated. So I do think keeping the masks in place for some time until we get further along in this vaccination rollout is going to make it easier to stay at that high capacity level without getting exposures, without getting cases among your employees and patrons and having to do quarantine and contact tracing. So I think we should separate those two things.
Dr. Adalja, the president will lay out the path forward on Thursday. And part of this is the mystery of what you're very comfortable with, which is these viruses. How do they go away? If we all get vaccinated, like for smallpox, or name the other horrific illness, or COVID, where do the bad viruses go?
Well, smallpox is the only human disease that's ever been eradicated, and that's really an exception that proves the rule. It's very hard to eradicate a disease. And a disease like COVID-19, which comes from a family of viruses that cause about 25% of our common colds, spreads very efficiently, and also has an unknown intermediate animal host, meaning we know it comes from bats, but we don't know where else it comes from. It's already when it's put itself into minks. That's not something that's going to ever go to zero. We're not going to eradicate or eliminate COVID-19. What we're going to do is make it much more controllable. We're going to defang it so it cannot cause serious disease, hospitalization, death, or ever threaten a hospital capacity again. So it's not something about making it go completely away. It's making it a manageable problem, more like other respiratory viruses. And the vaccines, all of them do that very, very well.
The question I think many people are asking, Doctor, is if we do get a new variant, how quickly these vaccines, these new mRNA vaccines can respond to that, the lead time, the lag time, so to speak. How quickly do you think we can respond?
Immediately. mRNA vaccines can basically be tweaked in a matter of days or maybe even a matter of hours. It's just a question of then having enough production capacity to put a new vaccine or a new version of the vaccine out there. But I don't think we're across that threshold, because even when you look at those variants, the variants of concern, P1 and 135, all of those, even in the face of those variants, the vaccines still stop what matters: serious disease, hospitalization, and death. And to me, that's the threshold that we have to worry about, not mild disease, but are people getting vaccinated and then getting breakthrough infections that are landing them in the hospital? The answer, to my knowledge, is no, that's not happened. And that, to me, is the threshold for where we tweak the vaccine.
Such a good final point, Doctor, and we appreciate your time and your ongoing contribution to this program, sir. Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. Tom, and that is the point, that these vaccines are just tremendously good at preventing severe disease, severe cases, and preventing hospitalization.
Well, the hospitalization comes down. All those numbers are good. And there was this worry of a plateau over the last, I'm going to say, John, 10 days. You can look at single data points. You can look at 7-day, 14-day moving averages. Everybody's got their surveys that they love. I look at 3 or 4, John, and I'll be blunt. The vectors are in the right direction. That's all we can say.
Up and away. Let's look at a single data point, Lisa. 2.17 million doses per day. That's your daily average over the last 7.
Round it up, John. Round it up.
Honestly, it's going really quickly. And the idea is that once you get the J&J vaccine out and you can actually get single shots, it'll ramp up that much faster. You do wonder, though, about the B117 variant, which is spreading pretty rapidly in Florida, and some of these other races that we have in other areas, just to insert a little bit of gloom.
Yeah, that seems to be the tail risk. No, I think you're right, Lisa. That seems to be the fair tail risk right now. For many people with a really constructive outlook over the next 12 months, that's kind of the one thing that still shines brightly for many people on the dashboard. What happens there?
Well, and there was just actually a case of the South African variant detected in Colorado. Just concerns around the edges.
From New York City this morning, good morning. Coming up on the program, Andrew Sliman, Morgan Stanley Investment Management Senior Portfolio Manager. It is Turnaround Tuesday. I think that's the thing, isn't it? It is now. Yesterday, upside down. Equities up 43, up a little more than 1% on the S&P 500. Yields come in 6 basis points. Your 10-year, 153. This is Bloomberg.
Just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. the destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates, being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
We're thankful to be able to come to a place like this and be able to break some stuff and release some tension without going to jail.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Yields are not so high that we're going to see a huge economic deterioration from here.
There's going to be a tremendous amount of fiscal stimulus that's going to justify higher yields.
There is a very strong correlation between the last two rounds of stimulus checks and the inversion you're seeing.
If the Fed starts talking about tapering their asset purchase program, I think that'll be negative for risk assets.
This is not a Fed that's going to hike upon a falling unemployment rate. And it's not a Fed that's going to hike when they start to sniff out inflation. They are going to wait.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
We have got a bounce back from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. NASDAQ futures up 2.3%, Tom Keene. We're off to the races this morning.
It's the way they're up, and they're up on GDP. I'm going to go back to first principles. Our guest, as we start this hour strong, will address that. And there's the back and the forth, and there's this and the immediacy, John, and all that. What we're looking at, as Laurence Boone of OECD told us from Paris, is 6% plus GDP. That is not a normal statistic.
Global growth gets a hike of 1 full percentage point off the back of a $1.9 trillion plan down in Washington, D.C. And to just look at how things have changed since the end of October. November, the forecast for the United States and U.S. growth from the OECD, 3.2%. What is it now? 6.5%. That's what has been behind the rally in small caps over the last 5 months. That's what's been behind the huge lift in yields we've seen in the last several weeks.
And John, as you mentioned in our last hour, folks, here on radio and TV, is a simple idea of rotation, the quality of it in the back and forth. In the sum of it, X the big text, John, is a lifting market.
Yep, cyclical is doing well, energy flying, banks doing terrifically, and everyone, Lisa Abramowitz, is a rate strategist. Everyone now is a 10-year
Even I'm a rate strategist.
Really? All right.
Whether you
Working
are a tech analyst, whether you are an FX strategist, in EM, you are all playing off the same story. It's in the U.S. bond market.
I think we haven't talked about this enough. The fact that Janet Yellen, the Treasury Secretary, came out yesterday and reiterated that she does not see this stimulus effort fostering an inflation problem. And this has been the real underpinnings of some of the sell-off in the bond market. Basically, yes, it's about growth, but it's about longer-term inflation expectations. And there is a growing amount of scholarship saying it can't be different. We're in the same trend. And John, that to me could be one of the big underpinnings of the rally in treasuries and frankly, the confidence people have.
They think the risks are asymmetric and they think we've got the tools to deal with it. And Tom, when they say we've got the tools, they actually mean the Fed has got the tools to deal with it. And I think that's the story here.
John, I know you've been big on the Fed. I know I'm a rate strategist as well. Guess what? I'm not. And what we maybe need are cash flow strategists like David Pearl in the last hour. John, 6% GDP. What does that do to nominal? What does that do to revenues? What does that do to global Wall Street as you come down the income statement? Can we dare say it will be a boom?
Well, Tom, that's why growth equities have struggled. That's precisely why. The story you've just laid out, and that's why the cyclicals have been flying. There has been a boom. I think we're already booming before the reopening has even gotten started. And I think you asked a really important question last week when Texas reopened. Who's next? If the CDC guidelines will remain this conservative, can you imagine the pressure that's going to build on state governors in the coming weeks and months, Tom, to reopen even more?
Yeah,
the CDC is saying if you've been vaccinated, you can spend time privately with someone else who's vaccinated. I don't know if the electorate will tolerate that. I imagine the pressure is going to build in an immense way in the coming months.
We all live our lives. You're out at some fancy restaurant. I'm at McDonald's yesterday, and, the CDC thing came out on my cell phone, and I showed it to the girl behind the counter at McDonald's, and she almost burst into tears.
Tom, honestly, I have no idea what you do in the afternoons. You went to McDonald's yesterday?
I was at McDonald's, yeah.
And you made the girl behind the counter cry?
No.
Did you get close to her?
No, I had my mask on, but there it is, vaccinated,
Moving on. This is what we looked like this morning in the equity market on the S&P 500,
nice
up about
data
40.
check, well-timed.
Really well timed. No idea what's going on there. Up 1% on the S&P, 38.60 in the FX market. Euro stronger, dollar weaker. Euro dollar 119. EM has just been brutal over the last 24 hours. EM got absolutely hammered in yesterday's session, and there's been a huge snapback today. So EMFX stronger, dollar weaker against G10 too. In the bond market, Lisa, there's the move for you. In 6 basis points on 10s, 1.53, 16%.
Yeah, I think we're all rate strategists is about right. Meanwhile, today, what I'm looking at is 10 a.m. The Senate Banking Committee is going to hold a hearing, another one, on the retail trading boom. This comes ahead of some of the stimulus checks getting into the hands of households. Also, we should be looking out for Roblox, which I believe is the love child of at-home remote learning plus Robinhood. Basically, it's got a direct listing and people are expecting it to pop. Anyone with school-aged children know that they have been educated by Roblox this year. Meanwhile, we're also going to be looking at the House. They were going to be discussing the stimulus bill, the $1.9 trillion effort, and probably going to pass it either later today or tomorrow. The key question is what next? Paul Krugman saying this alone not enough to get us out of secular stagnation, an argument that is hotly debated, and that there will need to be follow-on spending, and that is where the emphasis will be. And then at 1 p.m., the Treasury Department's going to start their bonanza of debt sales this year, this week, $120 billion of debt sales today, $58 billion of 3-year notes. The key question, John, who will be the buyers? Will it be the Fed? Will it be local investors? Will it be foreigners? Who is going to come in and see this as an opportunity at a time of, to Tom's point, 6% GDP plus, or to the moon? Potentially we could get 9, 10% GDP in the U.S. This idea, are we justified with these incredibly low yields, given the huge disparity in growth outlooks that's emerging?
Lisa, they're all going to show up. John, to your point on EM, I really want to point out the one telling tale is ADXY, the currencies of the Pacific Rim ex Japan. It's a big move, John. They're weaker by 2.9 standard deviations. That's a big move.
Well, let's go to a currency of Southern Europe, Tom. Dollar lira, 3% move yesterday in the dollar's favor. Turkish lira got hammered. Today, dollar lira down by about 1.62%. That's a stronger Turkish lira. They've been whipsawed. And I keep going back to this. Dollar lira, growth equities, treasuries, it's all been in the same bucket, the same trade, Tom, over the last month.
Now, I watch it again with the GDP numbers. They're going to come out. They're going to reshape earnings. They're going to reshape Q4. And to me and to our guest, John, here, the mystery is Q3 and Q4.
Let's bring in our guest, shall we? Andrew Sliman, Morgan Stanley Investment Management Senior Portfolio Manager. The mystery of 2022, Andrew. I always think about this in a 12-month rolling view. Things look good 12 months out now. What do they look like in about 5, 6 months, 12 months out? What does that look like to you, Andrew?
I think it's going to get tougher to make returns in equities. I think that, my basic view has always been equity returns will be easier during the pandemic than post-pandemic because Fed policy inevitably at some point is going to shift. Fiscal policy stimulus is going to shift, and at that juncture, I think returns become more problematic. So I think it's going to get tougher for equities later this year and into 2022. Not to mention also year-over-year comps next year are going to be tough. So I think the equity returns are now. It's a very good time to be invested in equities. It's going to get tougher.
Andrew, with that said, there has to be a timeline. When you dovetail with Ellen Zentner's work in the United States and, frankly, the rest of your team, what is your visibility on Q3 and Q4 of this year?
Well, like I said, I think the market is rallying in anticipation of that very good, good GDP numbers that Ellen is talking about. But it's not going to sit around and wait to see those numbers. I think the market will start to fade those numbers as we get later into Q2 return. So I'm solidly in the cyclical value positioning camp. I think it's overbought short term. I think we're going to get another crack at it. But I wonder whether we begin to fade that later this year from an equity positioning. Look, the area that has done horribly this year, as much as everyone's talking about growth, the area that's done horribly this year is the defensive stocks. And I think as an equity manager, I got to think about whether I want to increase my exposure to some of those defensive stocks later this year.
Yeah.
Excuse me.
Well, Andrew, there's also another question sort of underlying this, which is there's been a theory that higher rates affects big tech, affects some of the most loved stocks. It doesn't really affect some of the underloved stocks, the cyclicals, the areas that haven't gotten as loved, and actually helps financials. Is there a certain level that yields rise to where the cyclical trade starts to be threatened in a way that perhaps people are not considering right now?
Yeah, I really don't think 2%, 2.5%, and I think rates are going to 2% because the only thing that's not back to an all-time high, right? The stock market is, small caps are, copper prices, gold prices are all higher than pre-pandemic. The only thing that's not is where yields are. So I just don't think it's that hard to say yields can go back to 2% and we'll be fine in the stock market. It's just the rate of ascent that causes anxiety. So I think 2.5%. That's fine for a lot of equities. Now, that'll be really good for value. Now, the issue is that you've got some egregiously priced tech stocks, and they will continue to struggle. But I don't see the stock market overall. And I also, this is most importantly, the FANG stocks have done nothing since last summer. So I don't think they are extremely vulnerable if rates go up. But rates need to go up slowly. When they move quickly, that's when the market struggles. So, again, to answer your question, I don't think 2% is going to cause this massive unwind unless we're there, very quickly, and they're a massive problem.
Andrew, are we all rate strategists now? Do you sit there and watch the 10-year auction tomorrow, the 30-year on Thursday? Is that what we are now, though, Andrew? Is that what you have to do? Does Matt Hornback get on the phone and you just have to say, Matt, where do stocks go tomorrow?
Absolutely. Absolutely right. Like last week, I heard everyone talking about Operation Twist, and I thought, wait a minute, I'm no bond guy, but if the Fed's biggest worry is they're creating an asset bubble, why would they want to do Operation Twist, right? That would enhance the bubble. And then I thought, wait a minute, I'm an equity guy. Why am I talking about Fed policy?
Andrew, it's good to see you. Andrew Sliver of Morgan Stanley Investment Management. Tom, isn't that a story right now?
This is, folks, what you don't see behind the scenes is this is gospel for Lisa, John, and I. If you're an expert in the Fed, talk to Fed. If you're stay in your lane is a huge part of what we do.
But he's right. He was right with the idea that if the Fed's worried about a bubble, why do Operation Twist? And actually, the rate strategists were saying Operation Twist may be the right way to go. John, there have been different messages from the bond market and the equity markets, and perhaps there are fundamental reasons for that, but perhaps actually the equity investors have gotten it more right.
Well, there's two different complaints, and I've been harping on about that for the last couple of weeks, that Chairman Powell's stuck between a rock and a hard place. There's one complaint that he's too dovish, and that's the story here, that there's too much froth, and that's why yields are going high. There's this other complaint that he's not dovish enough and somehow needs to step in and count what's happening at the long end. And I just don't think in that environment Chairman Powell can win, Tom.
I'm going to watch labor. I'm going to watch claims. I'm going to watch the ability to migrate back to 4% unemployment. To me, that's the right timeline.
From New York City this morning, good morning to all. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Turnaround Tuesday on the cards here, up 40 on the S&P. We're up a little more than 1 percentage point. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
Okay, guys, let's play stop on profit for Japanese yen. I'm going to play stop on profit at 108.780. So whatever happened, we will end up in profit whatever happened, if the price will change its direction, you probably understand, we'll end up in profit. Okay?
Increase under former President Trump. A budget of roughly $708 billion under President Biden would amount to a decrease of about 2% in real terms once inflation is factored in. A highly contagious variant of the coronavirus is circulating in Florida. That's raising concern that a resurgence of the virus is possible in the state and beyond. The per capita rate of coronavirus patients in Florida hospitals is about 25% above the national average. At China's annual National People's Congress, the future of Hong Kong's electoral system is at stake. The NPC is preparing to pass a resolution this week to overhaul how the city holds elections. Critics say the move will tighten Beijing's hold over Hong Kong and leave no room for political opposition. And Bitcoin rallied above $54,000 today, hitting the highest level in 2 weeks. The digital currency has been rising steadily the last 2 weeks on news of more institutional involvement. Meanwhile, technical analysis from Evercore suggests that Bitcoin could hit 75,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Expect that face-to-face learning is the ideal, but I don't think that we are ever going quite back to that. What we're seeing is more of this integration of the technology into the day-to-day. We have seen that schools have had this kind of trial by fire in terms of trying to reopen successfully, and that many schools have had to use a system of using different ideas around what it would take to reopen and then pivoting when those ideas did not work well, meaning that some have had to go back and had to close. And that's been a global challenge.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
There's a prospect that with an all-out effort on vaccination and reopening schools, that we can really get the labor market back on track later this year or next year to, avoid what we had after the financial crisis, which was almost a decade before the economy ever got back to full employment.
Chair Yellen becomes Secretary Yellen, conditioned by the previous cycle in a big way. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your market action, your price action, looking like this Tuesday morning. Up 38 on the S&P, off the highs, but still positive 1 full percentage point. Out of the bond market, yield.
Okay, guys, position closed. 108,780. We're in profit. Depends on how much your broker pays you per pip. You made 2 pips just in about few hours, even less, yeah? Okay, well done, well done. I'll speak to you later.
With that still, Tom, but I agree with you. If we start to see better data points that lead to higher yields at the front end, that's when the Fed should start worrying about a credibility challenge. And we haven't seen much of that, but I'm with you. Just a little bit of a lift over the last couple of days.
Here's what we're going to do right now. We do economics, finance, investment. We do international relations, and sometimes we segue, and we can always do that with Kevin Cirilli, our chief Washington correspondent. Kevin, we got lots of topics to talk about on the Global Wall Street Watch, but one of them is thousands and thousands of children at the border. All of a sudden, we're back where we were time and time again with an immigration influx at the border. How critical is this for the president of the United States?
It's an opportunity for the Democrats to say that their major priority after the passing of the stimulus, which I'm hearing, by the way, tomorrow is when the House will vote on this, that immigration should be their next incentive. Now, there's been competing interests behind the scenes as to whether or not they should do infrastructure or immigration, but this will give immigration advocates evidence that they need to move forward with it.
Kevin, on that relief plan, what's the fallout of a plan that goes through the House without a minimum wage hike?
It's a lot of political capital. And, look, I think candidly, as the Democrats start to talk about things like immigration, start to talk about things like infrastructure spending, they've disappointed a core constituency of the Democratic base because they left out minimum wage.
How do they make it up to them?
I think that's the biggest unknown, is because for many of these Democratic progressives running in the midterms and jockeying with campaign issues, both in the midterms and in the next cycle, becomes a clear path forward. Yesterday I spoke with the Secretary for Veterans Affairs, Dennis McDonough. He's the former chief of staff to President Obama. He also served as the deputy national security advisor in the Obama administration and chief of staff at the National Security Council. And I asked him point blank about how do you create jobs in parts of the economy that are not going to come back. And he raised the issue of the semiconductor chip shortage. That is being directly linked now by Democrats, by the Biden administration, to manufacturing jobs. I think this is a very important nuance, because when you put it in the global supply chain speak, that this issue of tying this to manufacturing jobs presents arguably some more political capital for Democrats in need of it.
Well, and not just Democrats, but Republicans. Is there consensus around that semiconductor issue that can help push the infrastructure plans forward?
I think there is, but there's a lot of disagreement, Lisa, in terms of how to pay for it. I spoke with Senator Joni Ernst yesterday. She, of course, is one of the top Republicans in terms of negotiating energy policy, a Republican from Iowa, Jen Jacobs' country. And I was struck by how she said, in very plain speak, that President Biden's trying to have it both ways on energy policy. And so that, I think, is going to start to bubble over as well, especially at a hearing on Thursday in the Senator Joe Manchin controlled energy committee hearing on the weatherization of the power grids.
So, Kevin, we keep talking about all of the carrots of a Democratic administration, whether it's more spending on infrastructure, whether it's bigger stimulus plans. We're not talking as much about the sticks, the taxes, the higher regulation, and we have Biden, who is trying to fill his cabinet and his members of the FTC with people who have been vocal about even breaking up big tech. At what point in the year do you expect more of the sticks to come into play and perhaps fewer of the carrots?
You know, that's a really great question. And quite frankly, I think that there are many who are in the Democratic Party that are trying to assess the situation for big tech. You know, I did ask that to Senator Warren the other week, and she said that the pandemic, as we are now a year into this, has made her more concerned about the issues of big tech and breaking up big tech. There's a lot of mobility happening right now in the tech lobbying space here in the nation's capital. And when that settles down, I think that they will have more of a game plan to operate on.
Kevin, good to see you. Kevin Cirilli, Chief Washington correspondent and host of Sound On Bloomberg Radio, weekdays at 5 p.m. Eastern. Tom, it's not just going to be about the policy. Next year, it will be about one single data point, GDP in America. GDP in America, 5.5% the estimate for this year, 3.8% for next year. And beyond that, the focus on the disparity beneath. Have they done enough to close the gap?
I mean, look, Andrew Slyman absolutely nailed this. He nailed it. There's all this boom time. We all know China-like GDP is going to go away. We need to worry about getting to Michael Feroli's potential GDP under 2%. Yes, it's going to happen. John, I guarantee you it's going to happen. But along the way, corporations will mint money. What are they going to do with it?
It's the what next, Lisa.
And also, does GDP really matter as much, right? I mean, we're looking at inflation, we're looking at employment, we're looking at the wages, we're looking at some of these other measures that have longer lasting abilities. And we also are looking at whether this is just a U.S. exceptionalism story or whether this is global. And I do have to say, just going back to markets, if the dollar becomes strong, you have to wonder whether the global inflation story can continue in the same kind of way.
Yeah, I guess it's just a simple way to sort of cover a complex story. This year, we will see the boom. Tom, I'm with you, and most people agree on that. And I think I said yesterday that it's amazing that the bulls and bears all agree on the same thing. You will get that boom in a few months' time, bar anything happening with the pandemic and variations, etc. It's what happens within that boom, how your perceptions of policy change. What does the inflation pickup look like? How transient is it? And how does it shape your view about 22? And the view into 22, and I know it's only March, but the view into 22 comes into sharper focus quite quickly, I think, through the summer.
I think through the summer, yes, it's going to be there, and you can parse it from a societal worry versus a markets worry. But I would overlay, John, when really does the politics of November 2022 begin? I'll defer to Mr. Cirilli on that, but my guess is sooner rather than typically later.
It makes you wonder, Tom, how the bipartisan effort might look on infrastructure in the next several months, because that's going to be on the radar.
With the census, which I'm really watching, the redistricting, how do the Democrats lose the House? I mean, that's their worry.
Well, and then there also is a question going forward about Obama's era and how he was trying to negotiate and have a bipartisan bill, and he got stuck in the water again and again. So Biden is trying to go alone, and it seems like that might be the course.
It is a grand experiment playing out before our eyes, that is for sure.
That's what the show is.
We are throwing
the show is a grand experiment.
$1.9 trillion
it's a grand experiment.
At this economy.
How's McDonald's, Tom King?
I don't know if this is a successful experiment.
It's a
I can tell you that.
Experiment.
Futures up 37. We advanced 1% from New York this morning. Good morning. This is Bloomberg Surveillance.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal time for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
We're in the beginning of 2021. What are your biggest worries?
The inequality of the current world environment. It's troubling, and I think it's actually getting worse, which is a big challenge.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
From New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance, and here's the price action. This is your bounce back. This is your turnaround Tuesday. Equity futures up a little more than 2% on the Nasdaq, down yesterday by 2.4%. We take a big bite of that. On the S&P 500, 1% higher on the S&P after a move lower of about 0.5% yesterday. To repeat the point that Lou Wang made over at Bloomberg News, a quarter of that index made new 52-week highs in yesterday's session, and still we trade lower. It is the weight of big tech, and that is the story. Switch up the board. We are all in the same trade, and we are all rate strategists now.
Yes,
that's been the story, hasn't it? Just look at this. The Nasdaq over the last month, down 10%. Dollar Mex, Mexican peso weaker by about 6%. The 10-year yield up 37 basis points. And Tom, this is why everyone is so focused on the bond market right now, because it's setting the tone for tech stocks, for EM, foreign exchange, global equities, all of the above.
It's in every course, John. The bond market is always out front. The bond market is a dynamics. That's why everyone in the equity market always, as a first-order condition, listens to the fixed income strategists at their shop and, frankly, at other shops as well. The move back forward to that, though, is in the foreign exchange market. We're going to get to that in a minute. But, John, I have to have a GameStop update. I may go in a third time to lose money today.
You want a GameStop update?
I need a GameStop update.
Can I do the bond market before I get you a GameStop update?
Please.
Can I do that?
Please.
Maine, I think, is going to give you a Tesla update in a minute. He might give you a GameStop one too.
Bonds.
2s, 10s, 30s look like this. Yields are lower. It's the bull flattener. It's led by the long end. We're down by about 7 basis points to 224. On a 10-year, about 153. Romain, I have no idea if you were planning to do a GameStop update.
10.5%.
You are now. You are now.
Okay, well, I'll give it to you there. It's up about, it's not on the board here, but up about 10% in the pre-market. You might have missed your entry point yesterday, Tom, there, up about 41%. My guess is that the cyclical rotation going on in GameStop as a one-stop shop there, you might get your opportunity once again.
Are you telling me GameStop is a cyclical stock? It's like Ford Motor?
I think it's sort of like a vortex. How about that?
It's a vortex.
Yeah, just be careful, Tom. Trade safely. All right, let's take a look at Tesla here, though. I mean, everything John was talking about here, though, about all those stocks that got hit hard yesterday, and, of course, the eyes on the bond market. We talked about a lot about this yesterday on the close, and really the idea of sort of what's the line in the sand, really, when it comes to bond yields and how it affects the valuations on some of those names. A lot of people really said, look, the shakeout here right now has more to do with the volatility, of course, and the rate of change, but the absolute levels, not only with regards to what we're seeing on nominal yields, but on real yields, not really enough to scare people too much here. There also was a lot of concern expressed about how far some of these stocks have fallen. Tesla down 30-something% from its all-time high. Apple down 20%. And, of course, Snap down about 25%. That's probably why you're seeing bids come back into the market here this morning here. And the dichotomy here and really the transition that we saw last night, particularly with the NASDAQ entering into correction, and then, of course, with the Dow Jones Industrial Average flirting with a record high on the intraday. You flip up the board and you can see Yesterday, we also had, of course, a lot of those bank stocks also closing at record highs. S&P Financials at a record high. The KRX, that's the regional bank index, at a record high, and the KBW came just short of that.
I mean, stop that. It's really important, and this is what you're so good at, what you parse in the afternoons. Which part of the bank universe is doing better?
Well, the most yield-sensitive sectors. So think about a lot of those regional banks, some of the mid-sized banks. They did well, tremendously well yesterday. But keep in mind, you also had kind of the big money center banks also rallied yesterday hard too. You know, your Bank of America's, J.P. Morgan's of the world. But when you talk about riding that yield curve, when you talk about the transitions that we're seeing in the bond market and the FX markets, it is those mid-cap bank stocks that everyone has been gravitating to, the so-called value. You look at the factors on the Bloomberg terminal over the last week, over the last month, really year to date, it's been really value stocks and dividend stocks, and it's those bank stocks, those financial stocks that really hit that sweet spot.
Romain Bostic, thank you so much. Greatly appreciate it this morning. The close, look for that this afternoon as well. A good brief on where we have been through the day. Right now, and this is a really important interview, there's something about being in the crucible of market economics and market analysis, and not only getting it right, but getting it right with a certain verve. Mark McCormick joins us now from Toronto Dominion Bank, their global head of FX strategy. Mark, I want you to revisit how you framed the dollar 3 months and 6 months ago, and then, of course, give us the now what.
Sure, thanks. It's all about a rotation from the 2020 liquidity trade to the 2021 macro divergence trade. And so the dollar kind of sitting at the epicenter of that, the market was positioned purely on liquidity, purely on low rates, low term premium, and that was the benefactor of a weaker dollar. So if you only thought about what the Fed could be doing, you extrapolated that trend into a weaker US dollar for the entire year. Behind the scenes, growth was diverging. The vaccine campaign was getting off to better starts in the United States. And if you fast forward to where we're at now, we are seeing a much stronger dollar reconnecting with real yields because we're seeing more macro volatility come through the markets, through the VIX, through the move, and through currency vol. And that is flushing out all of these stale positions right now.
How do you respond, I should say, to the weak dollar crew? It's clearly consensus. I know they've got to cover that trade, but how do you respond to them and say there'll be a resiliency to dollar?
Well, I think it also depends, too. It's critical moving forward out of this positioning stage or this positioning element behind this transition of which basket you're looking at. We are still very bullish on the dollar versus the euro. But I think what you can think about is over the next month, after we see this rates move flushed out, there is an element where the factors that we're tracking in markets that are making money FX, it's terms of trade. So it's linked to the commodity cycle. It's about carry. So again, yield pickup is important, but it's critically most important. It's all about economic growth. So you can see a world where in G10, European currencies underperform, but you could also see currencies that are leveraged to the global reflation cycle still doing well. So your commodity currencies, your undervalued EM currencies, also EM Asia can outperform. So it's going to be, I think, a mixed dollar in the second half of the year. And that's part of this washout. As correlations break down and it's no longer dollar up, dollar down.
You've used that phrase 3 times. Wash out, flush out, and I want to talk about it with you right now. This is how you get whipsawed making big trades. You get sucked into what looks like a flush out, then you extrapolate it out as the new trend. Mark, how complex is that as you look at things right now, and how difficult is it to actually draw a line between something that's just a washout and something that's the beginning of a new trend?
Yeah, it's a great question because it's the context of the economic cycle. Are rates rising because the global economy is doing better? And that's a critical element. The taper tantrum was all about rates rising. We had mediocre economic growth through that period. What we see now is, if we go back to 2017 reflation, rates are rising because economic growth expectations are rising. What we absolutely are seeing now is a combination that is very similar to that, where rates are rising to validate the rise in global growth expectations, which is coming through on the normalization of economic mobility. We're starting to see the breaks between COVID numbers and economic mobility, which is a huge element where vaccines have changed the way that people can move around the economy more. So it's not back to pre-COVID levels, but there's a higher new level of equilibrium, which means we need more vol and we need higher real rates. So in the context of that, what matters for markets now is that real rates are validating the move in economic growth. And, you know, on the side of it, there's obviously liquidity and other technical factors that are happening in rates. But once this settles down, it's a good equilibrium for risk assets. And so it's not purely a return to U.S. exceptionalism. It's a blending of global reflation and exceptionalism, I think, for the second half of the year.
So another way of saying that is there's been a pain trade. It might be ongoing for a bit longer, but once that's over, the narrative that was at the end of last year will continue and reassert itself. Can you just talk about how much further the pain trade has to go?
Sure, I'd say we got at least another month. If we look at our positioning model, think about the pain trade. We're still talking about a dollar short that's a little under a standard deviation. So we are not even close to neutral levels yet. So even if you look at some of the valuation models that we look at, what we see is that G10 currencies are still slightly overvalued, where EM currencies are the one trading at a discount. So we haven't seen the full washout play out in effect. And again, we still probably have on the real rates models that we look at that are global macro based, we could still see another 25 basis points in real rates. So if you see that, again, in the context of the Fed coming next week, the ECB next week, we've got all these major central banks. If the moves are allowed to progress, suggesting that, again, that the economy is doing better, then that means there's more room for the dollar. So again, it's maybe in broad terms, another 1.5–2%. Again, against all major currencies. But again, euro is now testing the 118 level. We could probably see a marginal breakthrough there. But again, I would say this is probably about another month to 6 weeks in terms of this pain trade across FX.
Mark, I think the point you're trying to make here more broadly is that we're always looking for this broad-based directional trade that we can all just get behind and it chugs along through the year. And you're talking about nuance and dispersion. Within EM, walk me through the nuance now just to wrap things up. What's the favorite? Is there a LATAM lean? Is it Mexico? Is it the peso winner off the back of a huge plan in DC? What is it?
So what's going to be interesting is because each of those baskets is going to trade differently. So if you go through LATAM, you'd probably want to pick currencies that are leveraged to the commodity cycle, leveraged to North American growth, and also trading at cheap valuations. So our EM team likes selling dollar MEX rallies. And again, you can see there's a nice discount. And if we get the 1.9 trillion in U.S. fiscal and a 3 trillion infrastructure package, North America looks solid. You got the Canadian dollar, the Mexican peso should outperform other currencies across other regions.
Right.
And again, if you go to something like the ruble would do well in that backdrop as well, given it's linked to commodity prices. This is also like we like Norway.
Mark, I got to be wicked quick here. We're out of time. I know you're a rate strategist as well. Do the foreigners show up to buy the auctions?
Well, that's a big element. I think that's a big part of what Priya's call is, along with the U.S. rates team, is there is an element where supply is going to drive up rates a little bit higher in the short run. So the auctions can not go maybe as well as people are expecting, and that's part of the continued sell-off we get in rates in the next month. And that would also drive this pain trade.
Mark, congratulations on your call. It's so out of consensus. It's just wonderful to have you on. John Farrell, what I think is so important there, as well as how all of this is dovetailed together when Priya Misra at 2% is talking to strong dollar Mark McCormick. That's interesting.
Yeah, Priya looking for 2% year end. Right now, huge bid at the long end, down about 8 basis points on 30s. 10s come in 7 basis points to 152. Equity market just rolling over just a little bit off session highs. We're up 32 still on the S&P, Tom. Up a little more than 0.8%. I think the key here, though, to Mark's call is to think about things a little bit more nuancedly, that we're going to have dispersion. It's not going to be a clean, synchronized global growth story. And the other point he makes that I find absolutely fascinating, and it's important to think about, that a flush out is very different to the beginning of a new trend that we can all get behind. And the risk is always the recency bias. You take the price action of the last month and you start extrapolating it out 12.
John, what's so important about this, and this goes back to David Goldman and Robert Sinch at Bank of America years ago. You know what? There's a complexity to this analysis. Simple analysis usually doesn't get it done.
Coming up, some complex analysis. Chris Verone, Strategas Head of Technical and Macro Strategy from New York City, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The House takes up President Biden's $1.9 trillion stimulus bill today. Sometime tomorrow, the Democratic-led chamber is expected to approve the measure. Treasury Secretary Janet Yellen is dismissing fears that the package is so big that it will cause an inflation problem. She says if it turns out to be inflationary, there are tools to deal with that. The European Union is set to go at it alone on a tax on tech giants such as Facebook and Google if there's no deal with President Biden and other partners. That's according to an early draft of a joint communique by Bloomberg. The EU leaders will discuss the digital tax at a summit this month. The Trump administration was prepared to impose sanctions if the EU went ahead with the tax. A Swiss drug maker, Adian Pharma, will produce Russia's Sputnik coronavirus vaccine at a factory in Italy. It's the first European production deal for the Russian shot. Italy's Prime Minister Mario Draghi has promised to speed up the country's vaccination campaign. And the founder and CEO of Zoom has donated more than a third of his stake in the company. According to filings, Eric Yuan donated almost 18 million shares of the conferencing technology firm last week. The shares were valued at about $6 billion. No word who the recipient is. And Gap is said to be considering a sale of its operations in China. Bloomberg's learned that deliberations are at an early stage and Gap could decide to keep the business. Revenue from Asia has been shrinking and accounts for about 5% of Gap's total. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
We will see huge scars for a long time, and many people are still in the pandemic. It's not over yet. So we will have to work for a long time to build up. Many companies have gone bankrupt. Many people have lost their jobs. Many countries have put themselves in a big trap, debt trap, and that will take a long time to recover.
Cecilia Malmström there, OECD Secretary General candidate, speaking to Bloomberg in the last 24 hours from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bramwitz, I'm Jonathan Ferro. Tuesday looks like this. Equities are higher by more than 2% on the Nasdaq. On the S&P 500, up 36. We advance 0.9%. Into the bond market we go, where yields are lower on 10s by 6 basis points and a little bit more on 30s. 153 is your yield on a 10-year. And in the FX market, the dollar showing some real weakness after a day of real strength. Euro dollar 118.93, up about 0.4%. Mentioning the OECD there, Tom, they were out this morning, 6.5% GDP growth for the US outlook for 21, and in line with Ellen Zettler of Morgan Stanley now. And the one that needs to catch up is the Fed. The Fed meeting in a couple of weeks' time.
In March 17, I believe it is. We'll do that show for you folks, and there'll be a mystery to that. The mystery will be if the 2-year changes 0.1587 right now. This is fun. Christopher Verone puts out a wonderful trend-based technical analysis. He and I know that it's all about relative performance, and that goes back to the legendary Dorsey Wright of Richmond, Virginia, who was decades out front on the relative sector analysis within technical analysis. Chris Verone joins us for Global Wall Street this morning. Chris, what do you see on a relative basis when you look sector to sector or across broader indices? What's the Dorsey Wright analysis this morning?
You know, I spent yesterday afternoon looking through the entirety of the Russell 1000, just name by name. And what impressed me is, even as we've been through this NASDAQ 100 route, this software route, and now this semiconductor route, the financials and the energy names and the discretionary stocks and the materials, they have filled the void in the absence of FANG. They have been leadership now for 4, 5, 6 months, and they've retained that leadership even as the market has come in over the last several weeks. So I think that's encouraging, and it's so much different than what we're used to over the last number of years. It was typically those types of stocks, the energies and the banks and the consumer names, that would lead the market lower. They've supported the tape here. I think we should take some comfort in that.
The S&P 500 has struggled, Chris, and you know why? It's because we haven't been able to take comfort from what's happened in growth. And for this market to advance, we need the growth story to stabilize. Do you see signs of that yet?
You know, I think we're in the ballpark of some type of a tradable low for the NASDAQ 100 type stocks. It got to a point, I think it was on Thursday's low or Friday's low, where fewer than 20% of NASDAQ 100 stocks were left above their 50-day moving average. When you're in an uptrend, when you're in a bull market, that generally gets you in the ballpark of some type of a tradable bottom, maybe within a couple percent of ultimately where things shake out. So I think that's notable. But what's interesting is the weakness in tech, it really hasn't spread to the broader tape. I mean, yesterday alone, you had about 30% of the S&P make a new high, right? So what has been concentrated, or where the weakness has been concentrated, has not really permeated to other corners of the market here, nor has it permeated into credit. I look at double B. Double B is about as contained as we've seen at any point over the last 12 or 13 months here. So what we've seen in NASDAQ is not spreading.
Chris raises a question here. At what point will big tech stop trading inversely proportional and inversely to treasuries? In other words, basically treasuries go down, so do big tech stocks. At what point will we see this break away?
I think we're kind of in that moment right about now. The 6-month net change on 10-year bond yield was in the 98th percentile of every historical observation we have in history. It would not surprise us to see 10-year yields pause somewhere in this 155 to 165 neighborhood. We're getting a little bit of relief on that front this morning. Maybe you trade bond yields back to 130, 135. I still ultimately think you're going to get a 2-handle on 10-year yields at some point in 21. I know we've talked about this on that show many times over the last several months. What really strikes me is if you look at the prior years historically where you've printed a 7 or an 8 or a 9% real GDP number, you're looking at 1950, 1951, 1955, and 1984, bond yields were higher, right? Yeah. So I do think we have to consider a 2% number on 10-year yields not being that out of the question. Now, remember, we're only 2.5 years removed, summer of 2018, with bond yields at 3%. And tech was holding up just fine with bond yields at 3% then. So I think this idea that tech is finished at 150 10-year yields, is a little short-sighted.
Chris, when will gold start acting as an inflation hedge again?
Oh, I wish I knew. I think gold wants to firm here. I think it's pretty flushed out. If you look at the flows into gold, they've just been liquidated over the last several months. And this is really the exact opposite condition that we saw by July, August of last summer, where just sentiment and excitement around gold was just so bullish. That has come off markedly as price has gone lower. You have big support in that 1650 neighborhood. It looks like it might want to hold there. I wouldn't be surprised, especially if the dollar starts to come off here. If dollar's overbought, dollar's still in a downtrend, dollar's near resistance, dollar starts to come off here, I think you can see gold start to firm again.
Well, if dollar starts to come off, they'll be looking for the next slice of the cyclical trade, and they'll look abroad for it, Chris. So let's just finish there briefly. DAX is at a record high. We know the Nikkei story over the last couple of decades and the last couple of weeks as well. Chris, take me to Japan and give me the why.
Japan's been our favorite for a very long period of time. It is the best market in the world that no one talks about. I bet you if we surveyed 100 people in this business, maybe 2 could tell you within a couple thousand points where the Nikkei even trades. This is one of the strongest trends that exist. It's overbought just like everything. I think weakness here has to be bought. The 1989 highs on Nikkei are still about 35% away. I think before this is all said and done, you're going to be back at the 89 highs in that part of the world.
Chris, I look forward to the conversation, sir. Chris Ferrone of Strategas. If we could show you a chart going all the way back to the 90s, Tom, there's a reason people don't know where the Nikkei's trading and why people have forgotten it. It's because you got absolutely hammered and you didn't recover until basically recently.
Yeah, there's just no question about that, John. I constantly run into this when I talk to people. They forget the scope, the scale, the size of the Japanese economy. And to Chris's point, there's some point where it wakes up. We've been waiting. I mean, I can give you endless anecdotes about the waiting and the waiting and the waiting.
That chart looks like a 30-year valley. That's basically that chart. On the Nikkei,
you adjusted for inflation or their modest deflation, and it's even uglier.
I got to say, John, that was so artful, trying to get him to reiterate his call on Japanese banks.
Ran out of time.
Which is one of the most,
there's a call there.
Controversial calls.
I think is pretty interesting.
It is.
We will cover that again shortly, I'm sure. Coming up, Jim Paulson, a Luthold Whedon Capital Management Chief Investment Officer. On this Tuesday morning, we bounced back on the S&P 500, up 33, up almost 0.9%, off the highs, but still doing okay. In the bond market, yields are lower across the curve. On 10s, we're down by 5 basis points. On 30s, we're down by 6. Again, this move is just coming off the boil a little bit from where we were a little bit earlier. Similar move in the FX market, euro dollar, 118.91.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
The 1.9 trillion U.S. stimulus, we think that will lift and global GDP growth by about a full percentage point.
We're about to have a $2 trillion stimulus, so the propensity of consumers to spend is very high.
There's going to be a tremendous amount of fiscal stimulus that's going to justify higher yields. This is not a Fed that's going to hike upon a falling unemployment rate. And it's not a Fed that's going to hike when they start to sniff out inflation. They are going to wait.
Fed policy inevitably at some point is going to shift.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, simulcast Bloomberg Radio, Bloomberg Television as well. John, I thought International Women's Day was wonderful yesterday, and Abby Joseph Cohen said it better than anyone. Wipe away the gloom, 1.9 trillion, up, up, up. That's what we get this morning. I'm sorry, John, the gloom is endeth.
Never mind the day. Let's talk about the dominant call of the last month. That's been from Ellen Zentner of Morgan Stanley.
Yes.
And everybody else started to follow. 6.5% GDP growth for the United States for this year in 21, and maybe 5% in 22. And I think one of the most powerful things that could happen a week tomorrow from the Federal Reserve when they meet is upgrading those forecasts and keeping the dot plot almost exactly where it is. And in the worlds of nil data of Renaissance Macro, Tom, that's passive easing.
And Michael McKee would say those forecasts really, really matter. What I think is important, John, honored to have Lawrence Boone from Paris with OECD on us, and she made clear it's not just about the United States. You can get that lift Abby Joseph Cohen was talking about worldwide.
To see a plan down in D.C. make that much of a difference to a global forecast is amazing. 1 percentage point of global growth added on, primarily because of the fiscal plan down in Washington. And who are the winners going to be? And we need to talk about that because the forecast for the US has effectively doubled. Will it be Canada? Will it be Mexico? Does it really bleed over to the rest of the world, Tom? Or does this just fuel that story of the US decoupling for the year ahead?
Futures up 33, NASDAQ up 2.1%, up a little more earlier. And Lisa, you know, you go one way one day, one way the other day. Lisa, in your research, what do you see out a month, or dare I say, out 3 months?
Well, that's when the gloom will actually end for people who can start traveling again, who could get employed again, right? I mean, the gloom ended November in markets. Let's be clear. Right now, we're still on the precipice of the end of gloom in the economy, in social life, the idea that we can get back to normal. And the question is, can we sustain momentum in markets through the economic boom when you do have this idea of inflation?
Right.
That, to me, is the big push-pull. Longer-term inflation expectations, one of the most contentious issues right now, Tom, that I see in markets.
Okay, so Lisa, let's go wicked narrow here. The mayor de Blasio yesterday opens the high schools of New York City. What does that symbolize to you?
It symbolizes that he's under a lot of pressure to get the schools open again right now. And it also highlights the issue that we have heading into the end of this year when kids aren't necessarily going to be vaccinated, high school students perhaps. At what point do you prioritize public health? At what point is this just an issue of mitigating some of the most severe illness going forward?
Okay, I want to go wicked wide now. We go narrow with de Blasio. With John Farrow, I'm going to go wicked wide right now on our simulcast. John, I'm going to look at the 2-year yield. That is the depth of the short-term market, and it's coming up a little bit. John, where does that...
Economic data, and so far it hasn't. And I think that was the case study of Friday. Blowout jobs report, how did the 2-year react? Didn't
Not
really
much.
react at all.
Yeah,
And that will be the key for the Fed as well. At the longer end, they can call that a statement of confidence. If you get yields higher on a better outlook, at the front end, if you start to get yields higher at a 2-year off the back of better data that's not consistent with their own dot plot, that's where the credibility challenge starts to get a little bit more fuel. And I imagine that's when the Fed starts to lean in aggressively, verbally, to begin with.
Cherner, I'm going to do the data check and mention some of our guests. Mark McCormick with that outlier call, stronger dollar. We got a churning dollar today. Swiss franc weaker as well. It's real simple on the futures, up 34. The VIX comes in 31 on the gloom, comes into 24.82. I'll let John worry about the market as he flogs the real yield here through the coming hour. Right now, we're going to stagger to Minneapolis. There was a freeze there. It's a gorgiosity, 67 degrees, heading towards New York. James Paulson joins us now, Chief Investment Officer, Luthold Whedon as well. Jim, how do you recalibrate given all the turmoil of 2020 into the first 3 months of this year? How do you reset right now?
Well, I think I'm just most focused on, in my entire career, going back to 1983, Tom, my fastest growth rate I've ever experienced in a calendar year was 1984, when it was a little over 8%. I think we got a shot of taking that out this year, of having growth that's north of 8. And if we do, that's growth that we haven't seen maybe only a handful of times in the entirety of post-war history. And that is the big elephant in the room. You can talk about inflation coming up a little bit. You can talk about interest rates coming up a little bit. But if we have anything in that ballpark of growth, we're also going to have earnings which are much higher than people currently have forecasted for this year, probably more like $200 in the S&P 500. And with that, at least for this year, it's just going to be hard, I think, to keep a good equity down long term here over the course of this year, very long, if you're going to give me that type of growth. And if we're also talking like 5% growth in 2022, boy, we could have a lot of interest rate and inflation pressure and still have an equity market that could do pretty well in that environment.
So, Jim, I think that final point's the big point, 22. And whether this year ends in June and people start thinking about, hang on a minute, huge growth, we're all positioned for that now. What does 22 look like? What does 22 look like to you?
Well, I agree with that. I think, Jonathan, I'm pretty confident for this year. And if we run hard this year, let's say through the fall, we could get a big correction at some point. 2022 is going to be an adjustment year, I think, where we're going to have to figure out whether inflation's for real or not. And I'm still a little bit on the fence on that. Our policy officials have done everything they possibly could to create inflation, in my book. And we've done more than ever before to create inflation. The problem is, against that, we've got a lot of disinflationary force in the world with nasty and continued bad global demographics, including here. Yep. And also the leading force of the emerging world story, China has worse demographics than any of us. That's a pretty powerful displaced force. We've got a technology sector leading the world, which is nothing but eschews inflation or disinflation everywhere in its path, and that's going to continue overall. We've had falling monetary velocity for more than a decade, and so you could maybe handle a lot of money growth without the type of velocity we used to have. We have disinflationary mindsets in the world after 30 years of disinflation that are tough, I think, to change or alter. And I think we're going to get a pickup in productivity, because when I look back historically, when you have a big run in growth stocks over the last several years, that is followed rather regularly by a pickup in productivity. So my guess, I tilt a little that the inflation is going to be a burst coming in the next 12 months, and then it's going to calm back down again and maybe allow this recovery to continue for several more years.
Game plan time, Jim. Let's do it then. Growth's going to be better into the middle of this year. Inflation's going to pick up. The base effects kick in. We know all this. And what's amazing, I keep repeating it, take a bull, take a bear, they agree on the same thing. And at some point, you start to get that huge tug of war between the people that think it's transient and the people that think it's not, the people who think rates will rise and the people that think they won't. If you start to get volatility off the back of that tug of war, what's your game plan? How do you step into risk or step out? How do you approach that story?
Yeah. Well, I think you do a couple things. I think you want to minimize your exposure to bonds yet, and bonds exposures, interest rate exposure. I think you just want to have that absolutely minimized. I think you want to stay more cyclically orientated here, and I think you want to be away from the United States. This is a synchronized recovery, and those markets are coming back too. But they're not going to feel, I don't think, near the pressure that we're going to get here in the United States going into 2022 from overheat pressure. So I would have a good overweight away from the United States. Now, beyond that, I think it's going to be really difficult to call this correction when it comes, but we can all try. If we really get excited here, Jonathan, and we go a lot higher, let's say we blow through 4,000, go up to 4,400 or something here, I probably would take some octane off and park it in cash for a period of time and see if we can't get a sentiment correction that could be pretty big and pretty nasty. And if we do have one of those, then maybe reevaluate that point whether I think we have a sustainable recovery going on. Part of it is more information is going to come yet. Yeah. If we get towards this year end and the unemployment rate, is heading towards 4% or something, I have a very different approach perhaps going in 2022 than if we get there and we're still at 5% or something. How tight are the resource markets looking as we head into that next year? So I'm going to let some of that play out. But some of this also matters about whether the market goes nuts between now and then or whether it corrects.
So, Jim, there's also a question about big tech, because if you see the longer-term trend remaining the way it has been, a low inflation, slower growth environment, is it time to buy big tech on this dip?
Well, I'm underweight big tech. I just think it's not so much I have a problem with technology. I think they're going to continue to dominate the world over the next 5-10 years. I really do. But I think their earnings growth at this point doesn't look as good as relative to what small caps can be doing right now, or cyclical sectors, or even more commodity-oriented plays. But I would still own tech, and I still do. I just have an underweighted position. If you're going to win in this market, you got to be in the broader market plays, which are more cyclical, Lisa. The problem with that is it means that you're going to introduce yourself to downside draws that could be fairly dramatic. The way to balance that is to continue to own technology. When this market pulls back on overheat concerns, I think technology holds up a little bit. I'd much rather hold that than I would other defensive sectors.
Jim, really smart, sharp, as always. Great debate. Jim Paulson there.
Jim, thank you.
From Luthold Whedon Capital Management. This is an 11% move, a 10.93% move lower on the NASDAQ 100 off the February 12th high, Tom. Pretty brutal in a single month.
Well, but it sustains through the morning as well, and we'll see how it goes back and forth, and every conversation is great. I love that phrase, John. I'm taking the octane off triple leverage cash.
Is that what you're doing?
I'm taking the octane off that triple leverage cash call.
Yeah, what are you putting it? Bitcoin?
We're looking for an entry point.
Okay. That's never going to end, is it?
There.
GameStop.
That's never going to end. Okay. From New York City, for our audience worldwide, Tom Keene, never change. Futures up more than 2% on the NASDAQ 100. Julie Norman coming up from UCL on a monster plan down in D.C. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The OECD says that a U.S. recovery turbocharged by the new stimulus package will help power a faster than expected global upswing. And the report says Europe could be left behind. The Paris-based organization said it now expects global output to rise above pre-pandemic levels by the middle of this year. The Biden administration is now looking ahead to its next stimulus package, and it will face more obstacles than the one that's on the verge of getting through Congress without a single Republican vote. It will address infrastructure, climate, healthcare, inequality, and more, but Republican opposition to tax hikes will make it harder to pay for it all. The measure will be unveiled after the president signs the coronavirus relief bill. A highly contagious variant of the coronavirus is circulating in Florida. That's raising concern that a resurgence of the virus is possible in the state and beyond. The per capita rate of coronavirus patients in Florida hospitals is about 25% above the national average. At China's annual National People's Congress, the future of Hong Kong's electoral system is at stake. The NPC is preparing to pass a resolution this week to overhaul how the city holds elections. Critics say the move will tighten Beijing's hold over Hong Kong and leave no room for political opposition. And Bitcoin rallied above $54,000 today, hitting the highest level in 2 weeks. The digital currency has been rising steadily the last 2 weeks on news of more institutional involvement. Meanwhile, technical analysis from Evercore suggests that Bitcoin could hit 75,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
In the United States, we've been talking about this as a K-shaped crisis. People at the top of the income distribution have continued to do very well, and people closer to the bottom have been the hardest hit. It is an extremely unfair thing that's happened.
Secretary Yellen of the U.S. Treasury from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Tuesday morning looks like this. Here are the scores. On the S&P 500, we advance on the Nasdaq as well. It's a huge bounce back on the Nasdaq, up by more than 2%. On the S&P, up by 0.9%. The turnaround in the bond market as well. Yields lower by 5 basis points to 154. In the FX market, dollar weaker, euro stronger, euro dollar 118.87. These moves coming off the boil though, as this session grows just a little bit older. The equity market was higher. Euro dollar, euro was stronger. Treasury yields were lower as well earlier in the session. So we give some of that up just a little bit, Tom. Though I have to underline and emphasize what's happening here. That is Secretary Yellen, defined and really conditioned by her experience as the vice chair and chair of the Federal Reserve in the previous cycle. And that's the huge turnaround. So many of them on the FOMC have been totally conditioned by what happened last time, and they want to wait it out on monetary policy, and they want to go hard and stick with it on fiscal.
I can't emphasize enough, John, her experience with that key word of her tenure, slack in the labor economy. That's absolutely original as Treasury Secretary to have that back down. John, what do you presume is an unemployment rate where Yellen is all clear?
I've got no idea, because last time around, what was it, Tom? 4%,
way low.
And it could have gone much, much lower than 4%. And I don't even know if the headline unemployment rate is the thing they look at anymore at the Fed. In fact, we know they go beyond that now. That won't be the driving factor for them in the same way. Part
of that is a two-part American economy, and that comes to one of our themes percolating here, and you know it's going to be getting bigger. Let's get a brief from Julie Norman. Stimulus will pervade out into the global economy?
Well, Tom, obviously for Biden and the Democrats, they were thinking mostly domestically with this bill, really trying to provide this relief on the one hand and stimulus on the other. But you're exactly right that this will also have ripple out effects also, largely just because of the size of the bill, $1.9 trillion going out into the U.S. economy is just by its very nature going to have ripple out effects. At the same time, Europe and the UK, where we are, has been also taking its own measures, also pumping a lot of government money into their own economies at the same time.
You are expert, and frankly, the whole UCL shop is, on the measurement of austerity, the austerity of John Farrow's England, the austerity of Europe. Is the U.S. dead with austerity? Have we pushed austerity aside permanently?
Well, Tom, I think one thing that we see in this bill is certainly a pivot away from austerity politics. Not necessarily in terms of the lawmakers who voted for it, but definitely in terms of popular support for the bill. Over 62% of Americans supported this, even though it's one of the largest bills in history, and really seemed quite open to this kind of government spending in order to help in areas where people just seem to feel there was indeed a grave need right now, not only for COVID tests and vaccines and whatnot, but for helping schools, for helping with health insurance, child tax credits, housing, nutrition, et cetera. So there seems to be a bit more appetite now for government spending than I think there was 10 years ago.
And Julie, to John's point earlier, there is a renewed appetite for spending because what happened in the past is that the frugality of the United States didn't work. And one thing that's fascinating is you're seeing diverging efforts both in China, where they're taking the opposite tactic and putting less stimulus into the economy because they were scarred by some of the empty cities and the roads to nowhere. And you have the U.S. doubling down on stimulus because they had the opposite experience. Can both approaches be right?
Well, I certainly think they can, Lisa, and that's just because obviously those two contexts are just so different. I mean, China, you have working from an economy that has shifted from having over 50% extreme poverty just 20 years ago to now being down to about 5%, just one of the sharpest declines in extreme poverty we've ever seen. Whereas the U.S. obviously being at a place very differently 10 years ago where the economy is doing very well and then trying to recover from that very sudden jolt. So both economies are always going to respond to that very differently. China, of course, trying a lot of different policies that will probably work better there. They saw what happened with reaching too big with some of those ghost cities, but it certainly hasn't hurt them overall.
There's also a question, Julie, of how much this environment in the United States has been facilitated by low rates. I mean, have you studied at what point that starts to matter? How much policymakers have to look at the Treasury yield, basically, to determine how much to spend?
Yeah, of course. Well, I mean, obviously, we've seen that narrative as being part of what's justifying these current policies, and many economists coming forward and saying that the rates are making all of this possible. I do think there's some need to be cautious with that, and we've heard some economists, even some Democrats, saying that, especially with this bill, that it could heat things up too quickly, that we can't just count on these rates to be lower to have this effect forever. So I think that's something to be careful to watch out for, indeed.
But one final question, Julie. If we heat up, isn't that a requirement to employ the bottom third or the bottom quartile of America?
Well, I know that's certainly what you all were talking about just before with Yellen and trying to address this employment slack. And that's obviously going to be an aim for Democrats as well, to bring that unemployment number down as far as possible. In terms of how much they're able to do that coming out of this recession, what kind of bump there will actually be and how long that lasts, I think is yet to be seen. And what we're seeing now with this current bill is very short-term measures, and to what extent they can translate it into more long-term policies and long-term effects on the economy, I think we'll have to wait and see.
Julie, always great to catch up and always appreciate your insight and input. Julie Norman there, University College of London, political science professor. And I think what we often forget after we're about to pass a $1.9 trillion plan, Tom, is that we passed the 900 billion one back in December. It's only a couple of months ago. So this is 900 billion on top of 1.9 trillion that might get signed off on in the next couple of days.
The payoff here is growth, and the timeline, John, the experience is the timeline's not 3 years or 5 years. It's going to be a growthiness and a hope modeled out a decade, modeled out 15 years to get out of this natural disaster we've been in. And that's the timeline CBO is going to use. That's a timeline adults are going to use. And frankly, the market and the media aren't there.
The key word for this administration, Lisa, relief.
Yes, although I gotta say, you said the payoff is growth, Tom. And that's actually a question. Is the payoff growth or avoiding disinflation, avoiding contraction? And then is the growth gonna come from that second round of stimulus or the third round of stimulus that actually has spending on real projects? I mean, this is actually one of the key debates here when you talk about whether this is relief or stimulus.
Well, that waits for the next bill, frankly, but the growthiness, John, goes right to your point. What was this? And clearly, this is, whatever your politics, this is historically an income substitution and replacement plan versus what we've seen many times before.
Jared Bernstein leaned into the idea that this was a relief plan with a low multiplier, Tom, and we could debate that with our guest in just a moment, but that's why they believe that it won't be as inflationary as some people think. But hey, we'll see. Coming up, it's the big debate. David Page, AXA Investment Manager's head of macroeconomics, will weigh in on that debate. In this bond market, yields down 5 on the S&P. We advanced by 0.9%. That lift, it sticks. From New York City, for our audience worldwide, this is Bloomberg Surveillance.
will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio. Here's the cheat guide to today. Take yesterday and just turn it upside down. It is a turnaround. On the S&P 500, we advanced 0.9%. On a Russell, up by 1.2. On a NASDAQ, up by 2.2 after falling 2.4 yesterday. Switch up the board. I'll whip through things quickly for you. Next couple of days, really important for the Treasury market. 3-year auction today, 10s tomorrow, 30s after that. 10s and 30s rallying today. Yields lower by 5 basis points, respectively, on each of those maturities. 154 on 10s, 227 on 30s. Debate of the last week, when does the Fed start to get concerned about that? Well, the Fed will start to get concerned when this one changes. Switch up the board. This one, a little bit of it for you, Tom. A little bit of it for Lisa. This is the famed Bloomberg Barclays AG, the investment grade universe. And what you can see on this chart, and for our listeners on radio, I'll tell you what you can see, and that's not a lot. Just a little bit of an inflection point at the end here as we take borrowing costs back to where? Back to summer. Now, this is not a spread. This is the yield to worst, so to speak. And Tom, we have had that inflection. It's just not that brutal.
No, can I just...
It's just small. Lisa, you can go.
Make this one little point.
It's little.
Okay,
Come on, Lisa.
It is
it's little. It's small.
And yet, it has companies nervous. And they're starting to front load their borrowing now. And that is a key question. As they increase supply, does it exacerbate that move? And that is actually a key question for those, including Bank of America, if they just went underweight exactly for this
I
reason.
totally agree. For Bank of America, their big call is that this starts to widen out a bit, and it's the inflection point for the Fed to step back in. Now, hasn't happened just yet in a massive way, Tom, but it's happening.
Yeah.
And what's curious here is, yes, to Lisa's point, some issuers are trying to get ahead of this. We had a massive week of issuance last week, another big week this week, I think maybe in the 40 billion range. Is that right, Lisa?
Something like that.
That number sounds about right.
Sure.
We'll go with that number for this week. It's something like that. So a bit more supply this week. And that's what the Fed will be concerned about. If we start to see more people get worried, more supply, and those yields go much higher, Tom. But I think that's the bite point. The famed Bloomberg Barclays AG, the investment grade universe and the borrowing costs right now.
Well, there it is. And of course, this all comes down to the huge amount of debt out there worldwide after this natural disaster. I go back to the great fortune I had in my youth, folks, of a meeting with John Templeton. This occurred in Toronto years ago. It was a magical moment for me. He actually spent some quality time with me, and I'll never forget that Tennessee accent saying to me, "Tom, there will be a shortage of bonds." David Page joins us from AXA, the huge French effort on quiet money. We're thrilled David Page could give us wisdom here. David, there is not coming a shortage of bonds. So what then will yield do?
No, I mean, there's no shortage coming for quite some time, I think, the foreseeable horizon. And to our minds, there's obviously a debate going on at the moment. I think the two unknowns that financial markets are trying to price over the long term is, one, the scale of inflation that we're going to see generated when we see this rebound in growth that we're all now looking to see coming from the fiscal stimulus, and B, just how much of a change in the reaction function has the Fed come through. And I think bonds are toying with that, and it's rippling through other asset classes, because as markets accept that you see a pickup in inflation come through, you'll see break-even inflation come through. And that's not too much of a concern for the Fed. It's not too much of a concern for other asset classes. But as markets concerned that the Fed is actually not going to be as good as its word, that it is going to tighten monetary policy soon, real rates are rising. And that pickup in real rates is what's driving the dollar, is what's driving the concern in corporate spreads. And that's when the Fed, I think, will start to worry. So it's that play that markets are looking at now, the indecision between how the Fed's reaction function plays out against how much of a pickup in inflation we're really likely to see over the next year.
And David, I know John wants to go to the real yield because he needs to do the real yield on Friday. But David, I want to talk to you outside your remit about the great unknown here, which is how corporations and business adapt to this new world. How will C-class officers adapt to what they've been dealt by President Biden and by others?
Well, and again, that's one of the unknowns. What we're trying to see is whether or not this large pool that firms have and that households have excess liquidity, are they going to use that to pay down the debt that they've acquired over this period, or are they going to have a little bit more confidence that growth is out there and this is a good opportunity for investment? Now, if it's the latter, then we start to see a real drive of growth coming through. We may see a pickup in potential growth, and this could really underpin quite a material turning point in what's been a pretty bleak 10 years in terms of US trend growth rates over the last little while. But if we see a paying down of debt, if we see people sitting on this cash, not reacting, then there is a risk that you see a very short-term boost come through in growth, but something that fades thereafter. So part of this is, again, a confidence feature from corporates, the same really from households as well, about how persistent that's going to be. And that's part of why this stimulus has been so necessary.
David, when is debt inflationary and when is it deflationary?
Well, we'll see, I guess. I mean, basically, debt will be inflationary if we're starting to drive an economy significantly above its potential output. And that's possibly something that we could see in the latter years over the next few years. But at the moment, we come from a point where the US economy, for sure, but other economies even more so, are significantly in a period of excess supply. So we're trying to close the gap at the moment. We still have an unemployment rate that, once you take out all the funnies, is close to 9 to 10% in the US at the moment. We've still got unused capacity. We think that's going to close relatively quickly across the course of this year, and that's definitely helped not only by the stimulus, but obviously by the easing in restrictions.
David, I'd love for you to break down the $1.9 trillion plan, if you can, just the composition of it, and just run a bit of a clinic just in the next couple of minutes. This concept of a multiplier, the fiscal multiplier, when this money goes into the economy, how it rolls through the economy. Is this, just by its very nature, this $1.9 trillion plan, does it have a low multiplier? What's your take on that?
No, I think the multiplier by construction for this should be relatively high. I mean, what you're seeing is household checks going to households that are by design low income. They're unlikely to have significant savings buffers. They're likely to need this for income growth, and they're likely to spend it. That's sort of the historical backdrop of this. So a large chunk of that is going to go to people that actually want to spend the money. The same with the unemployment benefits. This is going to people that aren't thinking about whether or not they're going to have another holiday or not. It's going to people that actually need it to live. So we're going to see quite a high multiplier from that section of it. I think when we move into the PPP area for small businesses, again, it's likely that a lot of these small businesses that are taking down these grants are going to need to spend that. And I think that covers the sort of, the 1 to maybe 1.5 trillion, maybe a little bit less than that in terms of what we're covering. I think when you start pushing up to the 1.9, you do end up in areas where we're expecting to see a lower fiscal multiplier. So, for example, state and local governments, it's not obvious that all of those state and local governments have spent the money from the first CARES Act coming through. So when we see that coming through, then I think the money that goes to those state and local governments may not be spent quite as quickly. It might even be something that keeps tax rates down in the future. Yep. But that means that it's spent much lower, and it doesn't have quite the multiplier effect that other aspects do. So it's a range across, but I think the first portion of this 1.9 trillion is going to be relatively high multiplier.
The administration said to me on Friday that they think it has a low multiplier. And of course, the debate around this, and there's not much debate right now talking to you, it's pretty clear, is the impact this has on growth, on inflation. Now, the next point I want you to run us through is just money supply and the velocity of money. Money supply, we're all familiar with. Money supply has really started to widen out, broaden out in America. Can you run us through the velocity of money and what that means to your inflation outlook currently?
So the velocity of money is really what you do with that money. And the problem for estimating it is it tends to act as a residual. Now, what we saw in the GFC, which is another time when we saw a significant amount of liquidity created, was that this liquidity wasn't a signal of what people were going to do. It wasn't a signal that velocity of money was going to rebound and there was going to be a significant spending. It was literally that money was pushed into their accounts. Banks, corporates, households sat on that to some extent. It wasn't spent, it got reabsorbed, and there wasn't a significant boost that came through. And that's why we saw this big pickup in money supply and really no reaction coming through in inflation. Well, and largely speaking, we expect the money supply component of that to be the same. But we are in a different situation now. There are a couple of unknowns. We've got a bigger boost in money supply. We've got an opportunity coming through where households and businesses may choose to catch up on some of the lost spending that we've seen coming through. So if the velocity of money rebounds and we've got this large stock, then clearly that's something that's going to see a lot of spending and could create a significant inflation.
Wait, but hold on a second, David. But the question there is whether the checks to companies, to households that are lower income could cause that spending that we're talking about, not just checks in aggregate, but the specific, I'll get it out, 2, 3, 2, 1 to be top. The specificity of who receives those checks. I mean, is that your sense?
Yeah, I think the fact that they're skewed towards lower income people that are likely to spend it tends to mean that you're going to see a higher fiscal multiplier and tends to see that you'll see that new money that's coming through being spent because it's effectively making up for the lost income that the near 9 to 10% hidden unemployment rate is actually masking at the moment.
David Page, always great to catch up, sir. David Page there, VAXA Investment Managers. Just on the individual components of a much, much bigger debate on the outlook for higher inflation, Tom.
Yeah, I mean, you know, the debate is there. It's going to go back. John, to be fair to you, you're going to the Fed meeting. Maybe this will be a Fed meeting with a huge surprise, not just a forecast, but some straight talk about their belief on price change.
Yeah, to reiterate, for the Fed next week, next Wednesday, I believe, and I'm looking forward to the special you'll do with Caroline Hyde, Tom. These are the forecasts right now. 4.2% for GDP growth in America this year. LNZ and Morgan Stanley at 6.5. OECD at 6.5. 4.2. That's where the Fed is at. Yeah. Unemployment at 5 year end. Tom, they have got to go up and change on a GDP forecast specifically, and how they, in a corresponding fashion, move their dot plot, if at all, I think will be the story, obviously. And if we get this Neil Dutter world of Renaissance macro, which is what we've seen, where we get this upgrade to forecast, but not a corresponding lift in the trajectory of rate hikes, you've got an easier Fed, even though they've not moved.
I'm going to go all Tom Purcelli on you, David Rosenberg, and others. It's about wages. Where is there evidence of the when of wage inflation? I don't see it.
But that has been their consistent message. But John, to your point, how do they dismiss this faster growth and say and justify the low rate environment that they're in?
Growth.
I mean, this is the key question. How do they say, how do they transfer the focus away from that solidly to wages?
Quicker timeline for vaccinations, better growth ahead for 21, maybe even 22. And they've got to lean against rate hike expectations, and that will reappear in the dot plot. And as we've seen again and again and again, that dot plot is often a little bit more of a hindrance than a help. And I just wonder if that might be the story next week.
Right.
Got a final word, Tom, before I run?
I don't know. I'm going to go to break. I got to cancel my order on GameStop.
Okay. Dan Ives of Wedbush joining us on Big Tech.
No market. No, don't buy it at the open.
I need a break.
Here's a drink, John.
Futures rebound. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The House takes up President Biden's $1.9 trillion stimulus bill today. Sometime tomorrow, the Democratic-led chamber is expected to approve the measure. Treasury Secretary Janet Yellen is dismissing fears that the package is so big it will cause an inflation problem. She says if it turns out to be inflationary, there are tools to deal with that. The European Union is set to go at it alone on a tax on tech giants such as Facebook and Google if there's no deal with President Biden and other partners. That's according to an early draft of a joint communique seen by Bloomberg. EU leaders will discuss the digital tax at a summit this month. The Trump administration was prepared to impose sanctions if the EU went ahead with the tax. A Swiss drug maker, Adian Pharma, will produce Russia's Sputnik coronavirus vaccine at a factory in Italy. It's the first European production deal for the Russian shot. Italy's Prime Minister Mario Draghi has promised to speed up the country's vaccination campaign. And the founder and CEO of Zoom has donated more than a third of his stake in the company. According to filings, Eric Yuan donated almost 18 million shares of the conferencing technology firm last week. The shares were valued at about $6 billion. No word on who the recipient is. And Gap is said to be considering a sale of its operations in China. Bloomberg's learned that deliberations are at an early stage and Gap could decide to keep the business. Revenue from Asia has been shrinking and accounts for about 5% of Gap's total. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're in the beginning of 2021. What are your biggest worries?
The inequality of the current world environment. It's troubling, and I think it's actually getting worse, which is a big challenge.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We believe we're in a
K-shaped recovery. We believe earnings growth is going to be pretty explosive here. We believe that value and growth will do very well. We understand that rotation, but we also know there are minefields out there in value. So I think earnings are going to take out of this, and with each quarterly earnings report, we'll have more reasons to buy this market.
That is an important piece of audio from Catherine Wood. She is at ARK Investment. I'm sure all of you know who she is in the notoriety. And what is important there is how balanced her approach is versus the narrow focus on TSLA. Barry Ritholtz joins us now on the state of where we are. His podcast is required listening for Global Wall Street, longer conversations with important people. Barry, our running joke this morning is everyone's a rate strategist. Barry Ritholtz is a rate strategist. I want you to explain to all of our audience, and particularly the audience fixated on the Dow, why everybody in the Ritholtz world focuses on rates.
Well, the risk-free rate of return is your frame of reference relative to what sort of expected returns you can have in the equity markets and how much risk is out there. So when companies can borrow at no cost, it makes them more profitable and their stocks go higher. When consumers could get mortgages at 3% or 4%, it leaves that much more jingle in their pockets to spend and to drive retail sales. So the concern has always been there's no such thing as a free lunch, and if you keep rates down for too long, you'll kick off another inflationary spiral. Rates have been way below normal since before 9/11 in 2001. So that's 20 years already. That idea needs to be rethunk. Because so
like
far
that.
It ain't so.
Well, I like that. Rethunk. That's CFA level 4. Barry, Kathy Wood talks about how we will see growth and value participate, which to me goes to another theme of our morning, which is that corporate officers will adapt. Are we underestimating how corporate officers on a microcosm basis will adapt to stimulus? They'll adapt to pandemic change.
I mean, last time we had a conversation about how CEOs were one of the last groups standing in the public opinion polls because they adapted so well in 2020. But those are bigger companies. When we talk about adaptation, especially innovation, you have to look at the small companies. You have to look at the startups because that's what drives the major economic changes. It's just over an arc of years and decades. Eventually, big companies catch up. Look no further than Tesla. People forget they've been around a dozen years and they've completely changed the rest of the automobile industry. Nobody wants to get Amazoned by Tesla. And so, rather than lose, they adapted to EVs.
Well, sure. And Barry, that's the specific story when it comes to Tesla. There is a larger story here, though, that we've brought forward and that we've bought ourselves a bunch of years to grow into the valuations that we've given some of these equities. We've brought forward the returns. The equities have outperformed the economy, and now the economy will have time to catch up while equities underperform. Do you buy into that story?
Sure. I mean, it's certainly one possible path we can take. The old joke on trading desks is just because something's overvalued doesn't mean it can't stay overvalued for years and years and years. When you look at the long-term secular bull markets, anywhere between half and 3/4 of the gains come not from increases in earnings, but from multiple expansion, meaning investor sentiment gets more and more optimistic. They're willing to pay more and more for that same dollar of earnings.
Right.
We're kind of along the way in that process. It's a lot of PE expansion has taken place over the past decade.
Lisa, I want to point out NASDAQ up 300 points, up 2.5% now.
Almost completely erasing yesterday's losses, which raises a question, Barry, what it will take for people not to just buy the dip.
Well, it takes a long time to change that muscle memory, and you have to keep in mind, I mentioned secular bull markets. This 10% correction, 20% bear market is just utter nonsense. It's a terrible trope, and I think it hurts investors when they think about that. A bull market is not only that sentiment shift in terms of increasing willingness to pay up for a dollar of earnings, It's huge secular forces that change things. And that includes everything from technology and biotech and just how the economy shifts. You know, the classic example is post-World War II, when you had the rise of the automobile and suburbanization, and go down the list. There were so many things, electronics and commercial aviation. We have 100 separate industries that are all moving forward. Just look at what took place with mRNA. This was a glint in scientists' eyes 20 years ago, and now it's a game changer. There are hundreds of technologies like that. You guys know me. I'm not a permabull. Remember back to the great financial crisis. No one was more bearish than me. There are a lot of things to be optimistic about if you have a long-term perspective, a 10-year perspective.
Well, we're going to have to leave it there, Barry. We're out of time because we got to get back to the optimism at hand. Mr. Ritholtz, thank you so much. Look at his podcast, folks. Can't say enough about it. Lisa, you know, you really wonder, what is the why of this lift? And I'm going to go to your world. I think the why is there's a huge bet that the auctions won't be as ugly as what we saw last week.
We see a rally in treasuries, right? So this reverses some of the concerns that people had about yield curve steepening, about yields rising, and definitely about inflation. You do have a growing number of economists and respected officials, Janet Yellen among them, saying, look, we're plugging a deficit here. We're plugging a productivity gap. And after that, we can talk about stimulus. But right now, we're just continuing to plug that hole. And that is where the stimulus is. It's not going to be inflationary. I do also want to say, Tom, there is a question. Is debt ever inflationary? In and of itself, it is deflationary, but it is coming at a time when you have a recovery and you have investment in things that could potentially be inflationary. And this push-pull is leaving a lot of people trying to figure out how to maneuver.
Stronger dollar against the yen's for 109 overnight. Right now, 108.87 on yen. Euro goes 118.95. It's a churn here with the euro, the yen, the dollar as well. But all in all, it correlates back to a terrific equity market. We see it with the VIX in almost a stick from 31 in the Yanks there down to 24.62 on the VIX. I mean, I find that important. Lisa, what are you going to look for through the day?
Well, frankly, I want to see real yields, which are coming sharply lower.
Well,
I want to see 10-year yields, which also are lower. And I want to get a sense of how much people are ratcheting back their longer-term inflation expectations as they take stock of the secular stagnation argument that still Lisa, has some voice.
I thought you were going to Bitcoin. I mean, you know, back to 54,000. I mean, is anybody expecting Bitcoin to go through the recent highs?
Why don't you talk to your broker? Weren't you just talking to him about GameStop?
I took out the market order on GameStop that I had. It just moved so far, so fast. I'm going to wait and pause. And
they move in tandem, you know. So you can ask me
maybe I'll buy some GameStop when John's filming one of his properties. Who knows? We are up futures 41% there with the VIX 24.61. Please stay with us through the day on Bloomberg Radio, Bloomberg Television. The senator from Florida, Rick Scott, Balance of Power, the noon hour.
Says we should practice before we go to Mars, but some people say we need to practice on the moon. Well, you could practice on the moon, but you can do it at 1/10,000th the cost in the desert in Utah.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. It is yesterday in reverse from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now, 30 minutes away from the opening bell. S&P 500 futures at 1%. We begin with the big issue, the one issue, dominating equity investors.
The rotation. There is a real case for rotation. You're seeing the shift, that transition from growth to value. We're seeing the steepening of the yield curve play out. We're really due for this.
We'll see days where tech really bounces, but
rates are going to keep rising.
The recovery is coming.
We want to have shorter duration equities.
People are really realizing that duration risk is real.
How does it cyclicals do better?
It's a very straightforward one. That steepening yield curve, accelerating economic growth backdrop, underpinned mainly by the vaccination rollout. All of these things have been really supportive of this rotation.
Approach equities through the lens of fixed income.
There's a bear market in expensive tech and government bonds.
The markets are worried about how high Treasury yields could go.
They are lower this morning. Let's bring in the Bloomberg team, Kelly Lyons and Sarah Ponzek. Morning, Kelly.
Good morning, John. Well, you can chalk up so much of what has happened in the equity market to what's happened in the bond market because, yes, investors expected yields to move higher this year. That was the consensus call, but it's the velocity of the move that has caught the market by surprise. The 10-year yield exceeding the average strategist target for year-end by early March. It is in the last 30 days alone, so far from the end of January until now, the 10-year yield has risen by 50 basis points, up 61 points over the course of 2021 thus far, right now sitting at 1.53%. And what is especially important is the driver of that move, because it hasn't been inflation expectations. Yes, break-evens have picked up, but only by about 23 basis points, where the larger move has been in real yields. When you strip out inflation, the 10-year real yield moving higher to the tune of about 40 basis points so far year to date. It is now sitting around negative 69 basis points. Yes, that is still negative, but again, speed is key. So while we are seeing a bit of a recovery in the bond market today, yields coming in across the curve, the question is really how much pain still lies ahead. We're getting a ton of supply this week, John, starting with a $58 billion auction of 3-year notes today, then 10 years tomorrow, and a $24 billion auction of 30-year bonds on Thursday. If demand is weak, that could send the market spiraling once again. And then you have to consider where yields currently sit in relation to the growth outlook. The OECD just today doubling its growth forecast for the U.S. economy because of the $1.9 trillion stimulus package. And the average forecast among economists surveyed by Bloomberg is about 7.6%. That would leave the gap between where yields are right now and GDP growth at the widest since 1966. So even with the monster move we've already seen in yields, John, it does suggest there could be more pain ahead, John.
Kelly, thank you. No pain this morning, though. Yields in 6 basis points on 10s to 153. Sarah Ponzek, it has been vicious the last couple of weeks.
It has been vicious, and rotation really is the name of the game. Just consider the fact that over the past month, the S&P 500 has fallen 2.5%. Yet, if you look at the members of the benchmark, more than half have actually rallied over the same period of time. Now, of course, what this boils down to is just the market cap weighted nature, the structure of the benchmark. In fact, over the past month, every single energy company in the S&P 500 is higher. 90% of financials within the benchmark are higher. 70% or more than 70% of both materials and industrials names are higher. Of course, these are all cyclical members of the benchmark. Now, what this comes down to is the fact that only a third or so of tech companies are higher, and technology makes up more than a quarter of the benchmark. You can also see this reflected within equal weighted benchmarks, or an equal weighted version of the S&P and the classic market cap weighted version. This year, right now, you have the equal weighted version of the S&P really close to record highs. Over the past quarter or so, we have seen 6 percentage points of outperformance. That continues the 6 percentage points of outperformance we saw to close out 2020. This is on track for the widest outperformance of the equal weighted version since 2009, the emergence of the global financial crisis. And let's just zero in on yesterday too, because yesterday really just shows how even on a down day, the S&P 500 fell 0.5%. We're actually seeing a broadening rally within the S&P. For example, a quarter of the S&P actually hit new 52-week highs yesterday. So even in a day in which the S&P is falling, we are seeing a broadening rally. Usually that's not the case, but it really just comes down to the fact that your biggest members of the benchmark, they're the ones on the downside, John.
That has been the story. Sarah Ponzek, thank you. It is the weighting of big tech. Our colleague Lou Wang over at Bloomberg News running the following. Facebook, Amazon, Apple, Microsoft, Tesla. Take them out of the equation yesterday, and the S&P 500 was positive on the session. This story has all been about big tech, and that story in big tech has all been about treasuries. Take a look at this. 10-year treasury yields versus, let's say, EM currencies, and let's say versus the NASDAQ as well. It has all been one trade over the last month. Yields up 37 basis points, dollar MEX up by almost 6%, weaker peso. Yields up 37 basis points, the NASDAQ down by 10%. All one trade off the back of a treasury market. So let's talk about the treasury market. Bill Egan joins us now of JP Morgan Asset Management. Bill, great to catch up, sir. It's your world.
Right.
And seemingly everyone thinks they're a bond market strategist now. Seemingly everyone in the equity market is watching 10s tomorrow, 30s on Thursday. What do they need to know?
Yeah, it's really interesting what's going on this year in fixed income, because you came into the year and pretty much everyone was bullish that, well, the Fed's got your back and rates are never going to move up and everything's fine and you can feel very comfortable. The water's warm in fixed income. And now here we are, just a few weeks into the year, and already most bond funds are down anywhere from 2 to 5%. If you bought 10-year treasuries at the beginning of the year, you're down 6. If you bought the corporate bond index at the beginning of the year, you're down 4.5. The only place that's been any sort of refuge is high yield, which is basically 0 on the year. And even within high yield, there's a lot of speculative behavior going on. You've got double B rated high yield, which is down 50 basis points on the year, yet triple C is the worst of the worst in high yield. These are many times companies that are barely hanging on are up 10%. So a lot of interesting things going on underneath the surface of the fixed income markets.
Doesn't that just tell you, Bill, that it's been a duration story and not a credit risk one?
Well, it has been, and you make a very good point here, because if you think about it, the tighter spreads go, the tighter risk premiums go, the more everything moves toward just becoming a treasury, right? And right now, you're looking at areas of the market like investment-grade corporates, mortgages, even high yield. You're looking at the tightest risk premiums in history. So the problem you have now is that risk premiums across all extended fixed
Going to jump in on Bill Egan there. I think we've got a problem with his line. Bill Egan of JP Morgan Asset Management. Hopefully we can re-establish that connection and carry on that conversation, because I know Bill's got a lot to say. In your equity market right now, we do bounce back from the losses of yesterday. Let's get you some movers quickly and touch base with Abby. Hey, Abby.
Hi there, John. Well, it is really an impressive bounce back on the morning, as you were talking about earlier. The NASDAQ 100 futures up more than 2%. That, of course, after the NASDAQ 100 finished in a correction yesterday, still below that 100-day moving average. It's going to be interesting to see what happens. But as for the winners, not surprisingly, big tech, your Apples, your Microsofts, NVIDIA, Tesla, all in the green. Investors bidding these up as yields drop. Bonds having the best day in about a week and a half, so taking off those valuation pressures. Not surprisingly, that's hurting the banks. We have banks down on the day, so this rotation going into inverse today, greater than 1% declines for all of the big banks. And then finally, to end on a bright spot, John, on this risk-on mood that we have on the morning, Bitcoin is at its highest level in about 2 weeks, close to $55,000 per Bitcoin. We have all the Bitcoin names absolutely soaring. Investors want back in on that trade.
Abby, thank you. Thank you very much. Have a go do a little on the movers there. This has all been one story. Let's build on that. The tech analysts are now rate strategists. The EM strategists have always been rate strategists in America. They are even more so right now. At some point, the risks around this story become more symmetrical, and you start to lean the other way. And I think there's a risk right now, and I was talking to Mark McCormick of TD earlier on this morning about this, of conflating a short-term flush out with a longer-term trend. And that's always the story in markets. There's always a risk because of recency bias that you take the events of the last month and extrapolate them out 12. At what point does the risk around a 10-year treasury become a little bit more symmetrical and the moves start to go the other way, that you start to lean into growth again, into tech stocks, into duration even? We'll have that conversation in just a moment. Coming up on the program, House Democrats on the verge of passing President Biden's COVID-19 relief package. That conversation up next, hopefully, with JP Morgan's Bill Egan and Michael Fredericks of BlackRock joining us as well as we count you down to the opening bell in New York City this morning. Good morning to you all. It is a beautiful one, a warmer one, and this equity market is a hotter one, at 40 on the S&P. We build on the gains after the losses of yesterday, up more than 1% on the S&P 500 and a rebound on the NASDAQ as well. NASDAQ futures this morning up around about 300 points. This time yesterday, what was it, 5 Eastern? We were down about 2%. This morning, we're up 2.5%. Almost session highs going into the cash open in about 20 minutes. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Last weekend, as you know,
The House of Representatives passed our American Rescue Plan. This past weekend, the Senate advanced this landmark legislation. And very soon, the President of the United States, Joe Biden, will sign the American Rescue Plan into law.
The administration's COVID relief package heading to the House for a final vote. While it's expected to go along party lines, yet again with Republicans remaining united in its opposition. Senator Blackburn telling Fox Business the following: 91% of the bill is going to bailouts for blue states. It is going to loan forgiveness for students and for socially disadvantaged farmers. Democrats have just loaded this up and forced it through. Kevin Cirilli, Bloomberg Chief Washington Correspondent, joins us now for more. Morning, Kev.
Good morning. Get ready, because now it comes to deciphering just how much political capital the Biden administration used, not just for centrists, but also for Democrats. Chairman of the Energy Committee, Joe Manchin, a Democrat from West Virginia, saying that he hopes in future battles ahead, infrastructure, immigration, that the administration will be able to garner some Republican support. They're going to need that Republican support, mind you, especially if Democrats grow frustrated, and increasingly a handful of them could even depart in voting in lockstep with Speaker Pelosi in the caucus as a result of what they feel are significant progressive initiatives being let go, like the minimum wage. Now, in terms of the TikTok and where we go from the timeline, expect this vote in the House of Representatives sometime within the next 24 hours, and then expect the Biden administration and for President Biden himself to come out and to hail this as the crowning achievement of his first 100 days in office.
Kevin, you know how this works. It's always the what's next. This is going to pass. Most people in this market believe this has passed. Most people in this market have already started to price it. What's next?
You know, I think that we've been talking a lot about infrastructure and immigration, as we should. But yesterday I spoke with Secretary Dennis McDonough of Veterans Affairs. He's the previous chief of staff for former President Obama. He's also served in the National Security Council as well as the Deputy National Security Advisor. I asked him about job creation, and what he raised was the prospect of the global supply chains and the semiconductor chip shortage. If America is able to crack that code, that it could be a boost to manufacturing jobs domestically. That's a nuanced spin. It's a new type of pitch. And quite honestly, it has bipartisan appeal. That's what I'm watching today.
Kev, good to catch up, as always. Kevin Cirilli down in D.C. Let's get back to the guests, shall we? Michael Fredericks of BlackRock, and back with us, I'm pleased to say, Bill Egan of J.P. Morgan. Bill, we'll go at it again. Let's just start with that slate of supply that we get this week. Off the back of a plan that's going to deliver even more Treasury supply through this year. 3s later, 10s tomorrow, 30s on Thursday. Ugly auction 2 weeks ago on 7s. Are you worried about any of this?
Well, yeah, I mean, you were just talking about the stimulus bill and another $1.9 trillion coming forward. I mean, that's going to be a lot of issuance coming up. And I'm not necessarily saying that the auctions are going to be weak this week, but, you know, again, awful lot of supply to digest. When you produce too much of anything, it's going to impact the price at some point. And already, you know, you've seen the impact because rates are so low, you know, coming off zero. Just even small moves have magnified magnitudes on fixed income investors, which is why pretty much every bond fund out there is down anywhere from like 1% to 5% this year already.
Michael, at some point, the risks around the 10-year Treasury story become more symmetrical. Do you think we're at that point right now?
I think we're getting close. You know, a lot has been repriced. You know, we went from the beginning of the year with the market pricing in a Fed liftoff in sometime in early 2024 to now pricing in a liftoff in early 2023, and over the course of 23 pricing in something like 2.5 hikes. So that's become more well priced. You know, the market's looking for the 10-year to drift closer towards 2% by the end of the year. So it's come a long way. So I do think, like, we think the path of least resistance is still higher in terms of rates, but it's becoming more balanced. And with the backup in rates, you know, duration and owning some treasuries as a hedge, I think that starts to enter the equation. I was really kind of a non-starter for us at the beginning of the year when rates were, you know, hovering right around 1%.
Bill, dare I ask if we're getting closer to that point for you?
You know, for me, it's just not interesting enough. I'm an absolute return manager, and, you know, someone telling me, well, you can get a 10-year at 1.5%, I just kind of look at that and say, well, you know, the risk is not worth it. I mean, at the beginning of the year, everyone was saying, oh, you know, the water's clear, the water's warm, come on in, fixed income's great. And now, you know, everyone's starting to get hit. And, you know, I look at extended fixed income sectors, which are still priced for economic perfection. I mean, you got about the tightest risk premiums in history in most areas and the lowest yields ever in history in areas like high yield. It's just not enough compensation. The problem all comes down to this complete reliance on a third party to generate your returns. Everyone relies on the Fed. And what's the Fed going to do? And if the Fed doesn't do exactly what we think they're going to do, then we're going to have an issue. And, it seems like every time the market cries, the Fed sticks the binky in its mouth and says, okay, everything's fine now. That works until it doesn't. And, if we do end up having some form, if the economic forecasts that I'm hearing about all come to pass and we do very well this year and you do have some inflation with that, fixed income is not going to be a place you want to be. Now, on the other hand, if we deep dive into recession for whatever reason, rates generally are already priced for that, and yet spreads in extended fixed income sectors are priced for economic perfection. So no matter whether rates go up or down or the economy does well or poorly, you're still in a very precarious position with most areas of fixed income. So I'd rather sit and wait. And I think liquidity is very undervalued here. People are all still saying cash is trash. Well, cash is outperforming pretty much every fixed income sector this year so far, and liquidity works when you need it most, and that's when other people need it. And that's when sectors are selling off and you can actually reprice and get some cushion into your portfolio, which is not available right now.
Michael, add to that for us. Your cash position right now, how allocated to risk assets are you at the moment?
We're pretty fully invested. I mean, I think, to Bill's point, the setup for investment grade is pretty challenging, and we have close to zero in investment grade bonds. But high yield has done pretty well year to date. It's roughly flat, so it's absorbed this move up in rates. And frankly, I don't think there's a lot of downside there given the economic momentum. So if you're trying to make some money, we think that the current yields on high yield around 4.25% are pretty compelling. Like, it's not great. You're not going to make double digits in high yield going forward, but there's not a lot of upside. There's probably not a lot of downside either. And I think you can extend that to things like, there are parts of CMBS that we think are pretty attractive. There are parts of CLOs that don't yield quite as much, but, have probably are going to generate strong, or especially risk-adjusted returns. And I think if you're playing for upside, not a lot of upside in fixed income, you got to look more towards equities. And that's really where we're at pretty high levels in our funds right now. We're around 35% in equities. And I think that's where the upside is. That's where there's potential for price appreciation, especially if you're looking at some of the more cyclical parts of the equity market, and dividend growers is frankly a subset of equities that hasn't really caught a bid yet, but we think will as investors start to pile out of fixed income. $1 trillion roughly went into taxable fixed income the last couple of years. As Bill's pointed out, a lot of those funds are down on the year, and I think investors really haven't even begun to start to reposition yet.
Michael, it's interesting that you talk about a little bit earlier in the conversation about adding to duration, maybe that the risks around treasuries are a little bit more symmetrical. Yet when we talk about the equity piece of your allocation, we're talking about cyclicals still. We're not talking about the growth side in equities. If we have got a more symmetrical outlook around the risks around 10-year treasuries, isn't now the time to dip back into the growthy parts of the equity market, to big tech again?
Yeah, we're talking about that in real time. So, the tech is the bigger tech names, the more the oligopolistic tech names have pulled back a lot. And many of them are right around their 200-day moving average, which isn't something we focus on a whole lot, but we pay attention to, because for some subset of equity investors, that is important. So they've retraced a lot. And I suspect that retracement is probably in the later innings. But it was highlighted earlier, tech was roughly a quarter of the S&P, and these were really crowded trades that you can debate where we are in the unwind, but they've moved quite a bit. And some of that money is finding its way into the more cyclical parts of the market, which are frankly very small parts of the S&P. So I think we're more in the early to mid innings of this rotation. But look, some of the bigger cap and some of the bigger winners from the tech side of things. Even though we are an income fund, we are looking at adding some of those, particularly in the form of covered calls, where with vol so elevated, you can sell really out of the money call options on some of these tech names and generate a lot of income.
Bill, just a final word to you, sir. You're sitting in cash. You're sitting with a huge liquidity position, and you're waiting for an opportunity. Can you help me understand the roadmap for you, the signposts you're looking for to allocate that capital as the year progresses?
Yeah, it's simply an improvement in the opportunity set. Like I said, we're confined to fixed income. I have no issue with, with what was said about equities. I mean, if people are prepared to take that type of risk, it's fine. Put that in your risk portfolio. But fixed income to me is money that people can't afford to lose, and they're already losing this year. And when I look at things like, again, high yield at the lowest yields it's ever been, and you're pricing in basically a 2% default rate when the actual default rate in high yield is close to 7%. that's got to come down a lot just to meet the current pricing. So, to me, we are finding some opportunities in short-dated floaters on the corporate side, and within non-agencies, some well-seasoned pools and with good demographics. But outside of that, we're remaining very conservative, because the problem with fixed income is everyone talks about it on a relative basis, right? Relative this, relative that. So relative to governments, which are down 6%, I own corporates, which are down 4%. And the way I look at it is, on a relative basis, getting punched, I'd rather get punched in the side than punched in the face and break my nose. But on an absolute basis, they both stink. So, again, that's the thing you have to remember. Fixed income is a mathematical asset class. It's bound by the math. And the math is just terrible right now.
Bill, the issue you've got, though, just to jump in, is that what you're saying now was true 6 months ago, it's true 9 months ago, it was true a year ago, 2 years ago. We could have made this very same argument and just not moved in fixed income. Why is now unique?
Right. Well, it's unique in that, spreads relative, like, for instance, let's look at last year and how quickly things can change, because so much money in fixed income is held in ETFs, where the average time horizon, I would argue, can be measured in days rather than years. You look at what happened last March when you got the coronavirus scare. You had these middle-of-the-road fixed income funds go from being up in the year in February to down as much as 10 to 20% by the end of March.
Yeah.
That should not happen in fixed income. You should never be down double digits in a traditional, fixed income fund. Yet it happened, and now people have completely forgotten about that, and they're piling back into these areas of the market when the yields have really never been lower, or the risk premiums have never been lower. And at the same time, you've got central banks around the world saying they're not seeing any signs of excessive or speculative behavior, despite what's going on in Dogecoin and meme stocks and penny stock volume exploding. My only response to that is pretty much this. What are you talking about?
Bill, should we leave it there? Bill, come back soon. Bill Egan and Michael Fredericks, thank you. Coming up, the analyst acts you need to know. That'll be next in our morning calls. And later, the rotation out of big tech, taking a bit of a breather from New York. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Equity market rallying. Here are the morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Piper Sandler cutting its price target on First Solar down to $81. That stock up by 3.5%. Your second call this morning, it comes from Deutsche Bank, downgrading Blooming Brands to a hold. The analysts seeing a more balanced risk-reward on the stock. And finally, Wells Fargo raising its Viacom CBS price target to a street high, 82. There are three of the calls. Up next, the opening bell. Big Tech rebounds.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
25 seconds away from the opening bell. It is yesterday upside down on the NASDAQ, the S&P 500, in the Treasury market and the FX market too. NASDAQ futures, session highs up 2.5%, up 310 going into the cash open. The S&P 500 down around about 0.5% yesterday, up more than 1% going into the opening bell. There's your opening bell. Switch up the board into the bond market. Yields higher, then lower today, down by 5 basis points to 154. In the FX market, dollar stronger yesterday, weaker today. Euro dollar back with a 119 handle, up by 0.4%. Weaker dollar through G10, through EM. In the commodity market, just a break of 65, 64.77 on WTI, down 0.4%. That's the price action this Tuesday morning at the market desk with your movers. Here's Abby.
John, you just put it so well, saying that today is yesterday upside down. So the sector that was really hit hard yesterday, tech, it's on top. Let's take a look at some of the big tech winners, including Apple, Nvidia, Amazon, Applied Materials. Big gains here. Investors wanting back in on big tech as yields go down, bonds rallying just a bit on the day, taking off concerns and pressures around valuation. This risk-on mood is extending right into the EV, or the electric vehicle space, with Tesla, NIO, and other names, including Chinese EV makers. There was strong data out of China as well relative to February car sales, up 7-fold from a year ago. That, of course, was the depths of the virus for that country, but even so, very impressive. So a huge rally here. As for what's not working, yesterday's best sectors, financials and energy. Today we have the big banks lower, both JP Morgan, Bank of America down, and big energy is down too. So a little bit of a reversal, actually a big reversal, as you were making the case, John, from yesterday.
Last couple of months upside down, maybe. Abby, thank you. About 1 minute, 20 seconds into the session. Your sector composition looks like the following. Energy, financials have gone from top of the pile to bottom of the pile. Top of the pile now, IT, formerly bottom of the pile. Information technology up by 2.35%. The broader NASDAQ up by 2.3%. The S&P 500 up by 1%. Big tech bouncing back. ARK Investments' Cathie Wood revealing why she's staying bullish on some of these big names.
The earnings growth is going to be pretty explosive here. We understand that rotation, but we also know there are minefields out there in value. So I think earnings are going to take out of this, and with each quarterly earnings report, we'll have more reasons to buy this market. More reasons to buy this market. Is getting bought this morning, Sarah.
It is getting bought this morning after falling into a 10% correction, that technical level that denotes a correction. The NASDAQ 100 is staging a comeback this morning. You look at the NASDAQ 100 currently just a couple minutes into the session, and we now see the NASDAQ nearing a 3% gain, up 2.7%. Yes, it's early in the day. A lot can happen, but this would mark the 7th straight day of moves greater than 1% for the NASDAQ 100. Well, we just heard why Cathie Wood is still bullish on tech, but the question everyone wants answered is the worst over yet? Well, to give you an opinion on the flip side, RBC's Lori Calvasina, she put out a note early this morning saying that one of their positioning measures, well, it hasn't yet bottomed. At the same time, she says frothy valuations, that froth really hasn't been worked off just quite yet. Now, one for the bulls, though, if you're going to look at technicals, the fact that the 100-day moving average on the NASDAQ 100 has actually acted as support over the last 3 sessions. You see that right here. Yes, we have fallen a bit below it, but every day when we have been at risk of a deeper decline, that 100-day moving average has provided at least some support. But again, the underlying fact of this all is that this really is a concentrated sell-off. And the fact of the matter is, over the past month, the breadth has actually been to the upside. Today, you see the flip side of that with financials and energy lower. But take yesterday, for example, a day in which the S&P fell 0.5% on a points basis, down 21 points. You strip out just Apple, Google, parent Alphabet, Microsoft, Tesla, Facebook. Those 5 companies alone make up about a fifth of the S&P 500. Well, yesterday, the S&P 500 would have actually closed in the green if you took these out of the benchmark.
Amazing. Amazing. Sarah, thank you. Thank you very much. And that's why Wells Fargo's Chris Harvey is calling this a stock picker's paradise. Not just a paradise, it's necessary at the moment to try and get some gains away from what the benchmark is doing. Wedbush's Dan Ives recommending investors ignore the rotation noise. He writes the following: by tech, digital transformation is the 4th industrial revolution, and while valuations remain well above historical norms, so do the growth prospects. Tech stocks will move 30% higher in 2021. Dan Ives joins us now. Dan, let's just start right here. You're a bottom-up, single-name analyst getting smacked around by a macro storm. And I just wonder, from your perspective, for you right now, do you watch the 10-year Treasury auction tomorrow, 30 years on Thursday? Is that what you have to do in your job now?
Yeah, I mean, look, I just view it that a 40-bit move in the 10-year doesn't change our multi-year bull thesis on tech. And I think we're going into a golden age for cloud, cybersecurity, 5G, and the FANG names. So to me, this is the opportunity where you own these names on these sort of pullbacks. It's a pound the table moment. We still think NASDAQ 16K end of the year, despite all the bears yelling fire in a crowded theater that have missed the rally over the last year.
What's the price you want to pay for that growth, Dan? What's the price you want to pay for that story? It's a beautiful story. I've heard it. We all agree with it. What's the price you want to pay